So next, we are pleased to have Mr. Tan Ji-Tun for RHB Asset Management Singapore with us today. So Mr. Tan is the Chief Investment Officer of Asia Pac Equities in RHB Asset Management Singapore. He has over 24 years of experience in investment industry, managing multi-billion regional Asia Pacific equity and multi-asset portfolios. He is also a CFA charter holder. As you may aware, there has been no lack of volatility in China, and today he will give a presentation about China with a title, A Story of Reopening and Recovery. Without any further ado, I would like to invite Mr. Tan Ji-Tun to share his ideas with us. Let's welcome Mr. Tan.
Thank you very much, everyone. Okay. So before I start, I would like to thank everybody for attending this afternoon's session. I would like to also thank FSMOne Supermart for inviting me to speak at today's session. Okay. So the title of my presentation is A Bull in a China Shop. Okay, and a story of recovery and reopening. So before we go into the session proper, so let's talk about why did I say that it's a bull in a China shop. So what is the meaning of a bull in a China shop? In essence, it means that you need to be careful in your thinking and you need to be careful in your behavior. Okay, but also, why I chose the title A Bull in a China Shop, it's also because I am positive about the Chinese market. So in today's session, I will go through some of the China macro indicators of why I think China is in for a rebound, and also I will touch upon what are the key themes that I think are interesting for 2023. Okay? So the key macro indicators. So on this chart here, I have 4 lines here. So the first 2 lines here are essentially what we call the manufacturing PMI. So PMI means Purchasing Manager Index. It's essentially a survey that the government will send out and ask purchasing managers in the manufacturing industry or the service industry and asking them what do they think of their company prospects over the course of the next few months, whether are they going to buy more or buying less, what do you think of their prospects. So this survey is sent out to purchasing managers both in the manufacturing industry and the service industry. And how we read this chart is this red line here, which is the important line, which is 50. Okay, like when we were in school studying, right? Anything, when you pass an exam, when you pass a test, anything above 50 is good, you pass. Anything below 50 is bad, you fail. So same thing here. So anything that's below 50, which is below this red line here, it's bad. Right? So you can see this part, I'm sure you know what happened here. This is essentially the COVID-19 virus lockdown. Okay? So everything was bad. So everything is below 50. Okay? But I also want to highlight bring everybody's attention to December of 2022. Okay? December 2022, that was obviously the end of China's zero COVID policy. And once China's zero COVID policy ends, you can see the PMI numbers starts to go up very nicely. So this is the service PMI and manufacturing PMI. So let's talk about the manufacturing PMI first. You can see manufacturing PMI, is there a rebound? There is obviously a rebound. But the rebound has been rather weak. So why is that so? In essence, it's because China is still a manufacturer for the world, a factory for the world. And if, let's say, US is having a tough time, Europe is having a tough time due to the Russia-Ukraine war, and then obviously UK is also having a tough time. If the bulk of the developed market is having a tough time, then you can imagine, right, the demand for Chinese goods is going to be very weak. So that's why for the manufacturing business in China, things are not doing that well. They're okay, rebounding from the lows that we saw during the whole zero COVID policy, but nevertheless, it's being brought down by what's happening in the developed market. However, if you look at the service industry, meaning those in the restaurant business, tourism business, retail business, cinema business, those guys are okay. Because after being locked down in their homes for the last 3 years, once zero COVID policy ended, then they'll go out and shop, watch movie, eat at restaurants. So that's why the service PMI numbers are doing okay. nicely and way above 50. And that is also reflected in the actual numbers. So the previous chart I showed you are PMI survey data. So that, from our perspective as fund managers, right, we use that as leading indicators, indicative of what could happen in the foreseeable future. But this is real data numbers coming through. China retail sales, very nice. After zero COVID policy, you see this dip here? Went up very nicely, right? You can see industrial output also improved and growing roughly about 5%. Okay, so these are retail sales as well as industrial output numbers. So both set of numbers are recovering very nicely after the zero COVID policy ended. Next, let's talk a bit about inflation, right? So there are 4 lines here. The green lines or the teal lines are essentially the US CPI numbers. You can see this US CPI numbers, is it coming down? Yes, it is, but some would say it's not coming down fast enough. So that's why we are still talking about US interest rates being hiked for the next month's meeting. Okay, because it's coming off, but it's not coming off fast enough. But if you look at the pink line and the red line, that is the China's CPI numbers. If you can see from here quite clearly, I don't think there's any inflation scare in China as we speak. And that actually has a lot of implication in terms of policy measures, which brings me to this chart here. So this chart here, a series of lines, but you can see that's on a downtrend. So this is actually the benchmark policy rates in China. So on this chart here, I have 5-year prime rate, 7-day repo, 1-year medium-term facilities. In essence, this is essentially what the Chinese central banks are asking their banks to charge their customers. So the point I want to highlight here is, you can see that it's getting cut, right? The bank rates or the policy rates are getting cut. And that is very, very different from what is happening all over the world. US, we are talking about interest rate hikes. Our parts of the world, be it Singapore, Malaysia, Thailand, inflation is still there. So very few governments or very few central banks are willing to cut interest rate. But it's very different in China. China, because there's no inflation scare, so that's why the policy measures available to them are much broader and much wider. So that's why they're able to cut interest rate. And this is also one of the main reasons why I'm also very positive, because China is cutting interest rate. So for those of us who are afraid of the interest rate heights, of interest rate being so high all over the world, then you look to China. Look towards China, whereby they are cutting interest rates as we speak. And they have the latitude and the ability to do so because there's no inflation scare in China. Okay? Moving on, for those of you who are valuation sensitive, so on this chart here, I just want to highlight to everybody, this is the valuation PE or price earning ratio or PER of the China market. Okay, I've extended this all the way until 2018, right? So I can also share with you, during this period, this is the COVID lows, right? I'm sure all of you at that point in time will say, I wish I would have invested into China at that point in time during the COVID lows, which was in the April of 2020, right? If I invested then the market would rally, I would have made a lot of money. But guess what, right? For those of you who wish that scenario to happen, guess what? It's actually happening now. If you look at the valuation, of China market. It's actually at COVID low as we speak today. So I want to point out this very important aspect of the valuation to everyone here today. Is if you look at the lows during the COVID, right, which was in April 2020. In April 2020, for those of you who can remember, we were all running around trying to find toilet paper, trying to find masks. We don't even know whether we will live as mankind or not, because there's no vaccination, no nothing, right? Right? That was the point of maximum panic. And yet, at this precise moment in China right now, right, the valuation is as such. The valuation is as low as it was during the COVID period. So for those of you who are valuation sensitive, who want to buy cheap and good stuff, I'm sure all of us here wants to do that. Then I would urge you to look at China because valuation, like I said, is as low as what it was during the COVID crisis. And right now, I don't think all of us are worried about trying to find toilet paper, worried about vaccination. All of us have got multiple doses of vaccination already. We're not worried about whether we can survive until next year or not, right? Unlike during the COVID crisis. So that's why I think it's very different, and yet valuation is as cheap. Okay? Next, we move very quickly on this chart here. Okay? I know if you look at the market, it's very depressing, market's not great and all that, but I just want to highlight to everybody the reality. Don't look at the market, but look at the reality. So on this chart here, I highlight to everybody the GDP growth of different countries all over the world. Okay? The last three rows, right? The last three rows, US, Europe, and UK. I want everybody to look at the last column, 2023, the last three rows. You can see US, 1.6% GDP growth this year, Europe, 0.6, UK, minus 0.3. So these numbers are from IMF, International Monetary Fund, right? So even by their independent estimates, the developed market is not doing well at all, right? But in the real world, the world that we are living in, I urge you to look at the other columns. China, for example. What is China's GDP growth this year? IMF is saying 5.2. 5.2, I think, is decent, right? 5.2 in times like this, when the developed market is in trouble, 5.2, I think, is decent. Look at our parts of the world, which is in green. Malaysia, Thailand, Philippines, Indonesia, India. Are we doing okay? We're doing okay. 4 plus or 8, about 6%, right? And that is obviously quite decent relative to the developed market, okay? But if you look at other parts of Asia, Japan, Korea, Australia, and Singapore, okay, we are on average halfway in between now. Not as bad as the developed market, not as good as the rest of Asia, right? Because in this kind of economies like Singapore, Korea, Japan, we are also dependent on the developed world. So that's why our GDP growth is somewhere in between, okay? So this is the real world. For those of you who look at stock market and feels depressed, I'll urge you to come back to the real world. Okay? Next. Okay, I would like to touch on some of the key themes. Okay, some of the key themes that I think are interesting for 2023. Okay? So I'm sure everybody knows who this guy is, right? Ma Yun, right? Jack Ma. Right? This picture, I took this picture from the headlines 3rd of November 2020, about 3 years ago. That was when Ant's IPO was yanked at the last minute, right? Mai Jingkong was yanked at the last minute. And that was the start of the trouble in China. Tencent, Baba, the whole lot, right? It's not just Ma Yun, everybody, all the internet tycoons all got into trouble. So that was the start of all the troubles that we saw in the Chinese internet sector. But now, in 2023, things are very, very different. I would say it's 180 degrees different. Okay, this is another headline, but this is from, you look at the date, you might not be able to see the date, it's from 16 December 2022. So just last year, December of last year. So this one from South China Morning Post, what this essentially is saying is China is saying that, China government, central government is saying that, through the newspaper, is saying that they think that they should support the big tech company because big tech company supports unemployment, they should support the digital economy. So from my perspective, right, this really is a sign that there is a massive, massive change from the strict regulatory tightening that we saw in 2020 during the Ma Yun crackdown. And next, I'll show you this chart again. So this one came from Reuters, this picture. So this gentleman here is Ma Yun again. So this picture is very valuable. Why? Because this is the first time Ma Yun actually appeared after all that trouble. First time. You can see how relaxed he is. One arm behind the chair, while drinking coffee. So this is China. I'm sure this is post lah. Huh? Maybe they all don't know each other. I don't know lah, frankly speaking. But this one, it shows that he is relaxed. And that is also reflective of the mood, right? So this one, it was in the press, in the China press. And you look at the date, 27th of March 2023. So just a few months back. Right? So when I saw this, I think it further confirmed my view that the Chinese internet crackdown has ended because Ma Yun can appear in China and can appear on the Chinese newspaper. So all is forgiven. We can move on now. Right? And the best part is, these headlines, CNBC, because I don't want to say Kelong, we just only use the Chinese newspaper, CNBC. Okay, CNBC, 30th of March 2023. So just essentially 3 days after this picture appear, 3 days after this picture appear, we have this. Alibaba share price soared 15% because of the reorg. So those of you who are keen China watchers, you would know. Alibaba share price soared 15% because there was a reorg. It's going to divide into 6 entities, and they're going to list these 6 entities. And because of that, investors like ourselves think it's a great idea because it actually realizes the value of Alibaba. Right? It soared 15%. We are not talking about small kucing kurat, small little stock that can be goreng. This is Alibaba. Up 15% in one single trading session. Right? So I do think, once again, right, I think that's how powerful this change is. Essentially 180 degrees change from the crackdown that we saw in 2020. Now in 2023, things are changing. And why I want to highlight Chinese internet sector is this. Because the entire Chinese equity market, roughly speaking, 35% of the entire equity market is the Chinese internet sector. So for the China market to do well, Chinese internet sector needs to do well because it's roughly 1/3 of the market. At its peak, it was more than 45% of the market. So there's a long way to go. So I think if there is change, there is recovery, right? All these things are all happening within the last few months. Okay? So we look at the dates, and move on. But the other thing that I'm playing is also the reopening story. So this chart here, you can see, I'm not sure whether you can see this line here, but this is the historical trends of China international passengers. Pre-COVID, I can imagine COVID, dropped like a rock, right? This is where we are now. I don't think you can see. I'm sure those guys behind can't even see this, right? The whole point of me showing this chart is this. The scope for recovery is huge. It's huge. So that's why for our portfolio, for our fund, we are playing this. Because our view is that the scope for improvement is massive. And I want to show this chart as well. So this is the Macau daily gaming revenue, right? Pre-COVID, you can see this. This is where we are during the last Chinese New Year. Last Chinese New Year, you can see the scope for improvement is massive, right? So this is a few charts I want to show everybody to explain why we are positive on the reopening story and how we are taking advantage of that. Okay, next. The other theme that we are playing is also the China localization story. I'm sure all of you are well aware of the US-China tensions, all the restrictions that the Americans have put on the Chinese tech sector. So this is a sector that we are playing. We are embracing this US-China tension. I don't think for the foreseeable future they can become friends, right? So each of them will take their own path, right? And that's how we are playing. So we know who are the big boys in the Western sector. We know who the Intels, the Qualcomms, and all of that. But for the Chinese tech sector, who are the Intel, who are the Qualcomms? I think we yet to see who are these guys because they are still in its infancy, right? So that's why, in my perspective, then that's our job, to try to find who are the future Chinese Intel, the apples of the world, right? So right now, on this chart here, just to share with you, so this is China's total chip consumption, right? The domestic supply is only roughly about 25%. And because of the US restriction, this percentage will have to go up for sure, right? So this is a theme that we are playing quite actively in our portfolios as well. Okay, next, we like the renewable sector. We like the EV sector, we like the renewable sector. The main reason is because of this chart here. Okay, on this chart here, you can see, right now, roughly speaking, about 16%, 18% of China's energy needs are satisfied by the renewable sector. Right? China has a policy to be carbon neutral by 2060. So for them to hit that target, roughly speaking, about 3/4 of their energy needs to be from the renewable resources. So we have a long, long way to go. And that's good news for people like me, because this is a structural growth story. This is something that I can play because all the way from now till 2060, this is the path. The path is bright, right? So this is something that I really, really like. And moving on, I can also show you some of the data that we have here. So this is solar and wind energy installation over the course of the last few years. You can see massive, massive, massive installation happening within the last few years. Okay? And then what is also good is, in terms of the EV sector, I'm very positive on the Chinese EV sector. For those of you who have EV car, I'm not sure whether you're aware, the total cost of an EV car, right? The cost of an EV car, roughly speaking, 40% of the cost of an EV car comes from the battery. 40% comes from the battery, right? So this shows you how important the battery is to the overall EV cost. And guess what? On this chart, I have the EV market share globally. And we look at who is the biggest player here. CATL, obviously a Chinese company, LG Chem, Korean, Panasonic, Japanese, BYD, obviously Chinese, and then the Koreans as well. So why I like EV sector is because the battery guys are all in these parts of the world. And of the top 5, 2 of them are actually the Chinese. Right? So imagine, like I said, right, if a battery if EV vehicle, 40% of the EV vehicle is from the battery, shouldn't you buy the battery guys, right? Because some people always ask me, hey, should you just buy the EV OEM? Should you buy the Tesla, NIO, Li Auto? But the point is, I don't know whether all of you will buy Tesla or NIO or Li or Mitsubishi or BMW or Mercedes. I don't know. Right? You all might like the look of a BMW, some people might like the look of a Mercedes. But at the end of the day, if inside all these cars, it comes from the same manufacturers, then I might as well go and buy the battery makers, right? Right? So this is one of the main reasons why we are very positive on the Chinese EV battery makers. Okay? Next, from the Chinese perspective, you can see there was a massive uptick. There's a massive rush on the part of the Chinese consumers to buy EV vehicles or electric vehicles late 2022. The reason behind this is because there was tax credits that was going to end in early 2023. So 1st of January 2023, the tax credit is going to end. So if you want to buy an EV vehicle, what do? You buy before 31st of December to take advantage of the tax credit. And you see massive, massive uptick in EV consumption. And the Chinese government is obviously aware of that. So what? And you look at the news date, right? It's 2nd of June 2023. So just a few weeks ago. So the Chinese government came out and said they're going to extend the tax credit all the way until 2027. 2027. And this news just came out. And that also reinforces our view on why we are positive on the Chinese Chinese EV sector. Because from the policy perspective, from the tax perspective, the Chinese government are pushing, right, the EV sector, right? And therefore, our view, battery guys will do well. The EV manufacturers will do well as well because of the tax incentive, like we showed in the chart earlier. You got a massive uptick in terms of EV sales. Okay? Moving on, I want to touch very, very quickly on the Chinese property sector. So I'm sure all of you are well aware of the problems that the Chinese property sector had over the course of the last 18 months or so. So I won't talk about that. But I do want to highlight to everybody this part here. This part here. So this chart here, 3 lines. The white line is the price of newly built buildings, residential building in China in first-tier cities. Okay? The orange line is second-tier cities, and then the green line is third-tier cities. Okay, of course, over the course of the last few months, you can see prices all coming down because things are bad. But I want you to notice this part here. This part here, you can see very clearly that things are changing, at least on the price level. The prices in third-tier, second-tier, and first-tier cities are bottoming, right? Even though it's still coming down because we're still in a negative territory, but it's less bad now. And it's across the board for all the different cities. So it's not just one cities, but across the first, second, and third-tier cities. So what does it tell me? So for me as an investor, right, at least from a pricing perspective, which is more sensitive, I do think that we have seen the bottom. Okay? And for those of you who might have seen data that says that, oh, Chinese property transaction is down. So that's bad. So I just want to highlight to you, if you look at this chart here, right, I would argue that it depends on who you ask. Depends on which company that you ask. So these are the companies, Chinese property companies that we monitor, my team monitors, right? So the data is actually comparing the sales, actual sales, from January to April of 2023 versus January to April of 2022, last year. Okay, we compare these two periods, right? And let's not talk about the color first, but let's talk about here. So if you ask these guys who work for INF, Logan, Sunak, Shimao, you ask them, hey, how's business this year? They'll say, horrible, man. I think my company is going to jump up already. Because their sales are halving, half of their sales. But on the other hand, if you ask these guys, USU, Evergrande, Xialan, Collie, Greentown, Jingmao, Longfor, you ask them, how's business this year? They say, excellent. I'm doubling my sales. Right? So I'm sure all of you have seen data that says that Chinese property sales are bad. But I would urge you to look at the story underneath the data that's being published by the papers. You ask these guys, you think they think that Chinese property market is bad? I don't think so. Right? And now you notice the colors, right? So the orange colors are actually private property developer, privately owned. Okay? The green bars are companies that are owned by SOE, state-owned enterprise. Essentially has linkages back to central government or to provincial government. Okay? Then the green ones are what we call quasi-SOE lah, owned but somewhat owned lah. Okay? You can see very clearly, the Chinese people knows and understand this completely. If you are owned by the SOE, I will buy from you. You can see. Or the SOE developers are doing very, very well. Quasi-SOE developers are also doing very, very well. So they are making that distinction. If you're a private developer, if you're a small private developer, you are in trouble. I won't buy from you. Even if you cut price, I don't buy from you because I don't know whether you get my property or not. But if you're owned by the government, that's another story because I know. Right behind you is Xi Jinping. I will get my property one. So you see, they are doubling their sales. So I want to urge everybody to not look at all the TikTok, right? All your Douyin, and then believe everything you say, huh? Right? So you need to look at the underlying data because bad news sells, ma. Bad news will always 点赞 ma, right? Not? Right? You put the 小红星, right? So, but if it's good news, boring, right? Because it's human nature. But I just want to highlight to you, so that's why I want to highlight to you that the story is not so simple. Okay? The good guys, the guys who are doing well, who are well supported, are doing well in China. Okay? But the overall data will be weak because these guys only roughly constitute 30 to 40% of the market. These guys, the private guys, right, constitute 60% of the market and they're not doing well. Okay? Next, we move on. The best part is the Chinese government is well aware of that, so they are also pushing forward new property measures. This news came out very early as well, 2nd of June, just a few weeks ago. Chinese government is coming out with a whole host of measures to support the demand. So we are not just talking about loosening of the restriction, but we are talking about supporting demand in terms of cutting the down payment, cutting interest rate, which I showed everybody earlier. Okay? Next, I'm also very positive on the SOE, which is the state-owned enterprise. So state-owned enterprise reform has been talked about for years and years and years. Right? But I think this year, it's a bit different. Xi Jinping came out very, very strongly and talked about reforms. And he set to this SOE, enterprise management, very, very serious targets. Right? So we are hearing not just from one, but we are hearing from multiple SOEs, senior management at CEO level, at chairman level, that Zhongyang or central government is for real. And we are hearing this across different industries. So that's why my view is that I think for the first time in probably 15 years that I'm starting to take an interest in the SOE sector. Because I think time is right for change in the SOE sector. So that's why we are very positive here as well. Or starting to get more and more positive here as well. Okay? And also very quickly, I can't have a China presentation without talking about US-China tension, right? right? So this is a picture of Blinken going to China and shaking hands with Xi Jinping. So I'm not sure whether you all know the story, right? He was supposed to go during the Chinese New Year period. Then the balloon incident happened. The balloon burst, and then so did the meeting, right? So it didn't happen. So it's only very recently in June of 2023, then they met for the first time, right? And not sure whether you're aware, this meeting almost didn't happen. News came out at 3 p.m. on the day Blinken was supposed to leave. 4:30, they said, 4:30 he gets to shake hands with Xi Jinping. Yeah, the market rallied, right? So about 6 o'clock, then he left China, right? So meeting was slotted in last minute, very, very last minute. Okay, so there's a lot of things that came out from this meeting, but I just want to highlight 2 key points, right? 2 key points. And once again, you will notice, right? I took the American newspaper. Because if not, then you'll say I Kelong, right? So you look at the American newspaper, this is what CNN said. Blinken touts progress made in highly anticipated Beijing meetings. And the last part from Forbes is even more interesting. Blinken tells Xi Jinping, US does not support Taiwan independence, right? I'm sure that will take a lot of you by surprise because, why is he saying that? Right? The reason is because this is the official policy. You will hear a lot of news on your TikTok. Once again, I blame TikTok. TikTok, Douyin, social media, right? All of them, right? All of them saying, wow, US going to attack Taiwan. Oh, no, rather, China going to attack Taiwan because US is going to go there or whatever nonsense, right? But the truth is, so Blinken is the Secretary of State, which in our terms, right, he's the foreign minister. He's the foreign minister. The foreign minister of US already says, we do not recognize Taiwan independence. And yet there's so much noise going on, right? Because this is the politics in the US. So I just want everybody, once again, look at your TikTok, look at your Douyin, but you all need to understand that the foreign minister says, do not recognize. But the politics of US is as such that they will talk, especially this year. Why is it important this year? Because presidential election is next year. Everybody is fighting to be the presidential candidate. And the only thing that Americans can agree on is they hate China, right? Right? So that's why we have all these noises all coming through, right? So I just want to put everything in perspective. And also more importantly, very quickly, I just want to touch on the fact that the Chinese government is not also sitting down and not doing anything because they are doing their best in order to mend relations with the world. For 3 years, they've stuck in Beijing, cannot do anything. But now, things are different. So they brokered the deal, the peace deal between Saudi and Iran. And by right, in most instances, the guy in the center should be a white guy from America. But this time around, it's different. Right? So you can see China's independence I guess, China growing in influence of the world, right? They are not fighting US directly, but they are going around them, right? Okay, last but not least, just want to show this chart. I'm sure all of you are well aware. The renminbi is trying to become more important. I'm not trying to say that US dollar is not important. It will always be important one. 80% or 85% of all the trade in the world is all US dollar. China is roughly only 5%. So even if it double from 5 to 10, it's a big thing, but it's still 10%, right? So I'm not trying to say it will take over the world. It will not. But US, at the margin, will become less important, or rather less dominant, not less important, less dominant, right? But China will also grow in terms of influence. Okay? With that, I've come to the end of my prepared remarks. Thank you very much. Thank you, everybody, for your time and attention. Thank you.
Thank you, Mr. Tan, for sharing with us the story of China and what's in store for the economy in the future, as well as where are the opportunities lying for China. I'm seeing plenty of questions popping up already in Slido. No worries, we will address it later during the panel discussion. So, next in line, we have Mr. Yap Chi Ken, the Head of Investment Services for Eastspring Investment Berhad, who has over 24 years of experience in financial services and asset management industry. Now, I'm pleased to invite Mr. Yap up to the stage from Eastspring Investment Berhad to bring the title Asia Poised to Drive Global Growth.
Well, thank you, MC. A very good afternoon to all of you, ladies and gentlemen. 大家下午好. While Mr. Tan talked extensively on China, China is very important, I know. And I just want to take this opportunity to step away from China and in the region that we are living in Asia. Yeah. So I'm going to touch on Asia, and I'll talk about how Asia in the next decade, how Asia will drive the global growth in the next centuries. Now I'm going to touch on these three topics, mainly on Asia transformations stories. Of course, you know, China shouldered most of the blame when things didn't go right. And I think more importantly, if you look at Asia today, I think the story even getting more solid and is more interesting. Instead of just focusing on one country, China, we would like you to step away from China and look at the rest of the Asia. Yeah? And there are a lot of interesting transformation stories we would like to share with you today. Now, in the coming decade, you will see there are a lot of mega trend that we identify at Eastspring to be able to participate in this investment opportunity that we would like to share with you later on. And last but not least, how do we capture this investment opportunity in Asia? Okay, I'm going to start my presentation with this transformation story and really build on these three pillars. These three pillars basically are the driving force for the Asia transformation story, and you can see there are three pillars here. Number one, we have this diverse Asian economy. Now, if you look at Asia as a whole, right, there are so many countries. The interesting part is that each of these countries is actually going through a different economic cycle at different stages. Give you an example. Mr. Tan talked about how, you know, the challenges in China they have in property, in financial sector. But you look at India today, they're exactly on the opposite side. If you look at India today, right, their property sector, their financial market is basically at a multi-year expansion growth period. So this is very interesting because this is what we want to achieve in a greater portfolio with a broader market positioning. Now you can see a lot of opportunity here in Asia as well, simply because a lot of the countries here in Asia continue to make a lot of structural reform. Now Mr. Tan talks about the reform in China, the commitment to carbon neutrality by 2060. Now a lot of other countries here in Asia as well are doing the same thing besides China. We look at countries like Korea, we look at countries like even Malaysia and even India are doing that as well. So a lot of structural changes here in Asia, which give a lot of rebalancing opportunity for each of the country here in Asia. That gives us some, comfort in the sense that when you invest in Asia, right, despite the fact that there are a lot of volatility in the market and the geopolitical tension and risk, we are seeing some of these countries in Asia continue to rebalance their production value change in order to continue to find sustainable growth model in the region. So we are quite positive on that. And because of the technology advancement, we also see a lot of innovation here in Asia as well, yeah. Not only in Western countries, we are seeing a lot of good idea coming from China, India, even Singapore and Hong Kong. So with that, technology led this sort of innovation, and if you look at the other factor that we always look at is rising consumption in Asia. You look at the middle class in China, you look at middle class in India, even in Indonesia. Essentially, we are looking at a very strong domestic consumption story in Asia. That itself will bring a lot of opportunity in Asia. Now, traditionally, we have a lot of sector, for example, like manufacturing, financial, you even have like healthcare, and these are the traditional economic sector that have done very well. And because of this technology innovation, they will continue to innovate and continue to increase productivity. And as a result of that, we continue to see new economic sector to emerge. For example, EV, clean energy sector, and as well as digital economy. And these are the new economy actually emerging right here in Asia. So we are very excited in the next decade in terms of the investment opportunity. Now, in order for us to achieve this Asia transformation story, you can look at some of the key rebalancing enablers here in Asia. Very, very quickly, I just go through with you. A lot of the country here in Asia, basically, the policymakers are very accommodative in terms of improve the business environment. You can see some of the changes here in India as well. They continue to streamline some of the tax regime, continue to work on their labor market kind of policy. that also that also go through with Malaysia as well, Indonesia. So these are some of the enabler that we continue to see to develop in Asia. Now, if you look at a lot of the countries here in Asia, right, they also continue to expand their physical and digital infrastructure, continue to work on the connectivity for people to reach out to the different markets which are not accessible in the past. So with this key pillar in Asia, we strongly believe there are stories to be told and there are opportunity for investment to be made. Now, why a lot of the global investors start to look at Asia? For two reasons. Number one, you can look at the consumer expenditure. Now, the last decade, you can see in Asia, essentially, if you look at the compound annual growth rate is about 6.7%. But fast forward to another decade, right, in the next 10 years or so, right, we're going to see this number even increase to 8% compound annual growth rate, which is a very strong number that you are looking at. That's why everybody all over the world are excited to come to Asia to actually discover the opportunity. You don't have to look far, look at our parent company, Prudential. In the past, they have been really focused in the developed country. In the last couple of years, they start to do some demerger. They move away from the really crowded developed market, move to Asia to look for opportunity. Yeah. Now you look at the internet user in the key Asian market. Here I refer to a market like China, India, or Indonesia. Both India and Indonesia have a plan by 2030, right, to achieve a penetration about 80%. So from here, where they are to 80% is going to be a tremendous growth. So there will be a lot of infrastructure spending in those countries to upgrade their telecommunications sectors. Now, we have done a survey with a lot of the business leaders around the world, coming from US, Europe, or even in Asia itself, right? A lot of these C-level business leaders continue to think that India actually offers the most potential, and as a result of that, the transformation opportunity. Of course, China is important. They rank second, followed by Indonesia because of the infrastructure requirement and also because of the determinations to actually connect the people of Indonesia in terms of their financial condition. Yeah, if you look at Indonesia today, right, the penetration rate for their banking account or whatnot is still pretty low in the country. So we also see a lot of countries, for example, like Vietnam. When you look at Vietnam, you immediately think of China plus one, which is not true. China plus one can apply to any of the countries here in Asia. You can see a lot of the foreign direct investment also coming from the United States. Why they choose Malaysia? I think there's certain advantage over other countries as well. And of course, Indonesia has been very, very proactive in terms of getting China to work with them because they have the resources. They have they have these natural resources, for example, like the cobalt and the nickel, which is a key component input for the battery, the EV battery. So again, we are seeing a lot of opportunity, not only on the traditional economic sector I just mentioned, like manufacturing, healthcare, and financial, and it has slowly moved to a lot of very innovative sector, for example, like digital economy, electric vehicles. I think if you look at the development in China today on the EV, it's amazing. Can I have a show of hands? How many of you are actually driving the BYD right now? Nobody? Then you better go and make an appointment to test drive the car. I had the opportunity to test drive the car. I'm considering it at the moment. It is really interesting because if you look at all the panel design, all the gadgets they have, right, for the price you are paying, right, it's definitely worth it. Yeah, it's amazing. Yeah. Now, why Asia is important? Because if you look at the GDP growth as a percentage of the world GDP, right? As we speak today, probably Asia contributed about, I would say, 1/3. Yeah, moving forward to the next 10 years, the next decade, right? They're going to contribute more than 40% of that. Now, can you imagine from this 1/3 to about more than 40%? It's going to have a lot of opportunity for us as an asset manager to make some money. Yeah. Now, I talked quite a bit of the mega trend, and I want to take a step back to look at in Asia, right, how the GDP growth of each country has gone through in the last few decades. Now, somebody actually come up with this very interesting diagram. It's called the flying geese. You know how geese actually fly, right? One will be the leader and the rest will follow, and when the leader gets tired, somebody comes along and take the lead, right? And this is exactly what happened in Asia. Now, if you look at the left side here, you will see the different color coding. This basically represents a different period throughout the history. You can see that it started from 1960. You can see definitely Japan in the 1960 to 70, right? They are the pioneer, the powerhouse of the economy in Asia. Now, as times go by, you can see, right? You have this Asia 5 tigers. Sorry, 4 of them. The other one is a little bit shy, so maybe he's a marathon runner, so he take a back seat. Yeah. So you can see when these 5 tigers sort of slow down, right? This is where China stepped up again. In the last 3 decades, China has really grown the economy in a big way. You can see the number in terms of their GDP growth, almost like double digit, right? Only recently it slowed down to 5%. Now, as they slow down, right, you can see some of these smaller Asian economy start to pick up the steam. You can see country like India is growing about 5.8%. Indonesia also stepping up. Vietnam, even from Malaysia, you know, the one got lost, right? The only tiger that got lost during the transitions. Yeah. So this is a very good story to share with you in terms of how Asia, with the diverse economy, right, can actually take a different stages in your investment cycle. Now, I want to quickly share with you in terms of the key social economic indicator. These are the driving force behind why we think Asia is important. More importantly, I think what we have done is we divided the Asia into North Asia and South Asia. You can see essentially the population in the North Asia is a little bit more matured, and they have already achieved certain economic growth, which in terms of the GDP per capita is a lot higher than the South Asia. Now, this doesn't mean that the South Asia is not good. It just simply tells you that there are a lot of opportunity in the South Asia country like Indonesia, India, Vietnam, and the rest you can see from the chart here. Now, I also want to quickly share with you why this is important, because if you look at the second column, which is on the median age, right? This is not the average, this is the median. You know how the difference between the median and the average? The median age here basically shows you that it's right in the middle in terms of the values that you have, right? Now you can see in general, in North Asia, they are older than the South Asia. Now, why this is important, I want to highlight this because if you look at the fundamental foundation for a sustainable GDP growth, right, you need younger populations. Yeah, so this is why this number here is so important. Yeah. Now, the GDP per capita is basically a measurement of your economic growth. So it's done quite well in the past for North Asia, and we think South Asia will start to do well. Now, Asia has been a key player and will continue to be a key player in terms of the global export, wealth creation, because of the rising of middle class, right? You can see the number of, the youngster, in India. They are just like, in terms of the working population, young population, right? In the next 10 years or so, right, they probably contribute to 50% of the world populations in the young working class. So what I want to share with you quickly is that you look at the 3 different sectors here. Export of goods and services. Now, for Asia, you can see the last decade was growing about compound annual growth rate about 2.4, but this rate is going to accelerate to about 8%, in the next decade. So, as long as the global growth do not slow down substantially or go into a recession, we think the export in Asia will continue to grow substantially. And more importantly, you look at this consumer expenditure. In the next decade, you're looking at 8% compound annual growth rate. Very strong, yeah. For Malaysia, I think if you look at Malaysia's retail sales number, right, we'll be happy to achieve about 4 to 5% on that. And more importantly, this is something really dominated by the Western country, which is a patent registration. You know, when your product, when the services, right, you need to have a patent to protect it. Now, usually these are the game for the Westerner, but we are slowly seeing things are changing. Now, even as we speak today, right, the global patent registration in Asia already contributed more than 54% of that. So a lot of this are actually coming from a country like India, Korea, and Taiwan. Now, this is what we are trying to share with the public. Now, for you to participate in this region growing economy, right, the export, the consumer wealth, we think that the financial market is a way for you to expose yourself to take opportunity of that. Now, as a result of that, you can see the market capitalization for different countries in this region. Of course, you have China being the largest, in this region with about 11 trillion, yeah, and followed closely by Japan and Hong Kong and India. And if you look at India, the interesting part is that you can look at their growth rate in terms of market capitalization in the last 10 years or so. You're looking at double digit of 12%. So you sort of extrapolate that, right, in the next 10 years or so, right? We are not surprised to see, in terms of market capitalization in India will one day supersede, the Hong Kong and Japan. Now, let me just quickly share with you some statistics on how Asia will continue to drive this global growth in the next coming decade. Now, in the last 20 years, the contribution from Asia has been slightly below 50%, but fast forward to another 10 years, right, you are looking at about 57%. So from 49 to 57%, it is a very strong, about 12 to 14% sort of growth rate you are looking at. So what does it tell us? Now, this is basically the projection from the IMF. They are looking at, the global growth this year, yeah, as of April 2023, growing at about 2.5%. Now, out of this 2.5% global growth, right, China alone contributed close to 35%, and India another 15 or 16%. So combine the two, right, they basically contribute half of the global growth. Now, if you combine that with the rest of the Asia country, right, you're looking at about 60+%. Yeah, it is huge. It is major. That's why Asia is getting so important right now. Now, Asia being a regional hub for global export, of course, commodity prices are very, very important. As you can see from the chart here, right, post-pandemic, due to the pent-up demand, as well as during the start of the war between Russia and Ukraine, you can see the commodity prices actually shot up tremendously. But today, how many of you still pay attention to the war in Russia? That is like 1.5 years, It's a long process. It's almost as long as the pandemic itself. Yeah, and you can see things are slowly coming off in terms of the prices, and this is actually good for the exporting region like Asia. Now, I want to take a bit of time to talk about the infrastructure spending, which is very, very crucial for the Asia transformation story. Because at the end of the day, we are still a developing country. Most of the countries here are still developing, except for a few like Taiwan, Korea, Japan, right? For the rest of the Asian country, right, infrastructure spending is very, very important. Now, you can look at this chart here. I think what we have done is selectively choose some of the country, India plus the Asian country. Now, we look at the different period in terms of the government commitment as a percentage of the GDP on the infrastructure spending, right? You can see very clearly that they're actually on the rise, yeah? The number actually has slowly going up, yeah? But what about the collaboration between the private as well as the public? Now, we can look at this chart here on the right side. You can see China, you don't see a lot of private and the state government initiative. But countries like Indonesia, Philippines, India, and Vietnam, the partnership between the two is very, very strong. Now, take, for good example, Indonesia. Now, recently, you probably know about the news that the high-speed rail between Jakarta and Bandung is going to be operational. Now, even before they visualize that, Malaysia also have that, right? What happened to that? I mean, we have the Singapore and the Kuala Lumpur, the high-speed rail. Do we have the political will to do it? We don't. You know, from the conception until the execution or implementation for Indonesia is such a short span of time. And that is really the effort of the collaboration between the public as well as the private sectors. Now, China, despite the geopolitical tension that they are facing, and despite the restrictions imposed on them on the transfer of technology, you can see China continue to be very solid in terms of growing their export. Now, this chart basically shows you that in the last 5 years, right, how China actually has gained market share globally at the expense of the rest of the Western world. You can see China today contributed about 12.2% of the total world export, which is very, very substantial, yeah? Now, I think more importantly, they no longer export what? Your soft toys, your running shoes, The items they are export to the rest of the world have significantly changed over the year. You can see now, initially, they are quite strong in this E&E, electronic and electrical gadgets, right? But because of the trade tension, you can see some of this growth has actually sort of like fall off the cliff. But at the same time, you also have other sectors, for example, EV car. Now, on the daily basis, we continue to get a lot of news coming from China saying BYD is actually going to this country, going to that country to open new market. So there are a lot of, I think China is going to be the exporter of EV car for the coming decade. I think it's happening right now as we speak. So besides that, we also see a lot of some of this material like the battery as well as some of this solar. Now, by the way, Mr. Tan showed you that China basically one of the early adopter of the clean energy. They are really big in the wind and solar energy. Yeah? Now, this is where Eastspring thinks that going forward, right, the mega trend basically lies on the green, clean energy. Now, we strongly believe that if you look at some of the events that are happening in China right now, you can see, fast forward to 2030, right? In terms of the renewable energy, in terms of the contribution, right, they are going to achieve 57.4% of the global capacity by a single country. So there will be tremendous opportunity for the clean energy in China. Now, just quickly look at this chart here. I'm not going to spend a bit more time because I think the information are rather similar. China, it will basically take the market share away from the rest of the world in terms of the solar power. Now, in terms of the wind power, is also, they make a lot of commitment in such a way that you can see from now until 2030, right? You are going to see for wind capacity in terms of the growth, again, a very strong compound annual growth of 9%. So, a lot of things that we are seeing not only in China, but also in South Korea. I think one of the commitments the government recently made is that to develop this hydrogen economy. Basically, they want to, rather than depending on the EV, right, they also try to develop a new technology powered by hydrogen. Yeah? So you can see, even within Asia, there are a lot of new ideas, new innovations happening as we speak. Now, this is very, very interesting because usually, asset manager like us, we basically look at the broader market and we actually can slice and dice, to actually work on your products. Now you can see if you really want to look at sheer population, which are the 3 countries has the most population in this region and launch a product. You can launch an ICI fund, you can launch India, China and Indonesia. But you really like the idea of China and India, traditionally they are rival for the long time, and China slowly phasing out with the emerging of India, and you like to play the idea, you can actually come up with a fund called Crouching Tiger, Hidden Dragon. Yeah, basically, and not only that, you can also do a lot of different permutation, for example, you can choose, a team just focus on technology. You can have, your South Korea and Taiwan. So what I'm saying is that within the Asia itself, right, there are a lot of possibility and a lot of investment team you can continue to rotate for the long-term investment opportunity. Now, Mr. Tan also talked about the valuation, but I'm going to just quickly share with you. In terms of China, it is very, very attractive at the moment. Yeah, it's actually trading at one standard deviation below the long-term average. Be it on the price per book or PE, 12-month forward ratio. But within this Asia, right, we find one country which is quite interesting. Probably speaker this morning talks about it. Japan. Now, for the first time, we are seeing the manager in Japan, right, start paying attention to profitability. Because for the longest time, right, a lot of the manager in Japan don't really focus on that. Because we can look at this chart here. Can you imagine your profit margin as a percentage of your sales, right? It's only 2 to 3%. How to make money? I mean, how do you as a shareholder think about it? But there are a lot of structural changes in the last couple of years in Japan, and we're seeing a lot of these managers start to look at this number. And not only they are improving in terms of their profit margin as a percentage of sales, right? Now, if you look at this chart here, you're looking at the long-term trend, and it looks pretty good, right? But by the way, by the world standard, this is still pretty below the average. Yeah, they should continue to improve, probably close to, I would say, high single digit to low double digit kind of profit margin. So you are still looking at Japan as a potential market for further upside. And more importantly, I think they start to pay a lot of attention to please their shareholder, for example, like share buyback and giving dividends. So these are the real structural changes we are seeing in Japan at the moment. Now, with that, I just want to quickly sum up my presentation here. In essence, what we think that, in Asia, right, it is a lot of diverse economy. I mean, they are all in a different cycle of their economic development, a lot of opportunity. But moving forward the next decade, right, we strongly believe export is a key component. We strongly believe consumption, domestic consumption within some of this big economy in Asia will continue to drive this economic growth. And more importantly, a lot of the policy makers here in Asia continue to have very accommodative policy action to support the businesses. So with that, I think if you are looking at the investment which have a lot more broader market perspective, right? Asia is not a bad region to consider, rather than focus a very specific investment theme or sector. So with that, I thank you very much, and thanks for your time.
Thank you, Mr. Yap. Thank you for telling us on what and where to invest in the Asian market. Next in line, ladies and gentlemen, we will now move on to our next speaker. We have our next speaker who has years of managing Malaysian funds, Mr. Tan Gan Leong. So, Mr. Tan is a fund manager in CAF Investment Fund, Berhad, for Malaysia funds. He graduated from Monash University, Australia, with a Bachelor of Business, double majoring in Economics and Marketing, and he is also a CFA charter holder. Today, he will give us a presentation on Malaysian equities with the title, "The Future Belongs to the Optimists." Let's not waste any time and give a round of applause to Mr. Tan.
Hello. Hello, good afternoon, everyone. I appreciate the time you take from your busy weekend to attend my presentation today. Maybe some of you have attended my presentations in the past, some haven't. So let me introduce myself. I'm the designated fund manager for several of the conventional funds in CAF investment funds. One of the funds that was recommended by Fund Supermart, the CAF Vision Fund, which focuses on small mid caps. So today I'll explain to you the areas where I see opportunities and how I plan to navigate the challenges that we see today. Okay, so in this first chart, we can see the performance of the FBM KLCI against the FBM small cap index since the end of 2013. As you can see right here, since the end of 2013, which is about 9 years, the FBM KLCI have been down 26%. versus 5% for FBM small caps. So this is something that we have explained to our investors in the past, that we constantly emphasize on stock picking. This is one of our strategies and one of the philosophies of our company. Because we think that as a country, if you were to invest in the KLCI ETF, this is something commonly explained or actually highlighted by, investment gurus like Warren Buffett, where they keep telling people, buy ETFs, you outperform mutual funds, because it's cheaper, you save on management fees. That may be true in the US, where most mutual funds actually underperform the ETFs on average. But in Malaysia, that's not the case. If you were to buy the KLCI ETF, you'll be losing money like close to every year. So if you look at the last 2 years itself, it's have been a very challenging year. So we strongly believe that, if active fund managers in Malaysia, still can generate value for its investors. And if you look at this chart, you can see that small caps do outperform the large caps in Malaysia. The reason so is, there are a couple of reasons actually. The first reason is, why large caps in Malaysia have been underperforming. I think most people, have been talking about it and have been puzzled. Why the CI is so weak, year in, year out, because this is not something new, this is something that has been happening for the last decade. Why the Malaysian market has been so challenging for everyone. Now, I truly believe it's because, you see, in our Malaysian market, 40% of the components in the KLCI index is banks. So banks, the performance will be very reflective of the whole economy. So if your GDP is growing at 4 to 5% a year, you can expect that your CI stocks, the earnings will grow at 4 to 5%. But, we have to take note of one thing. You see, in Malaysia, the top 30 largest company, they get, if a company becomes bigger and bigger, they get included into the KLCI index. Last few years, we see the companies that are included in KLCI index, it's not because the earnings grew 30, 50% a year. What we saw was PE expansion. Companies trading at 30, 40 times PE. So when your companies who are trading at 30, 40 times PE got included into the KLCI index, over the years, in the next 1 or 2 years, more likely than not, they will disappoint than beat expectations of investors. Because when you're paying 30, 40 times PE for a company, you have very high expectations of its earnings growth. So, time and time again, we human beings, we have a tendency to extrapolate. So, again, they got included into KLCI, then after that, earnings disappoint, then, the stock price starts coming down, and then they got sold off, and then they got excluded from the KLCI, and then another new company, that's now trading at 30, 40 times PE got included in the KLCI. So you see, because of that, by nature, it's very difficult for the KLCI index to do very well. And then, of course, the 40% is your banks, and then your tenaga, which is, it's going to be very stable. It's going to be reflective of the whole economy. I think last 10 years, Maybank's returns are total return is about 4 to 5%. So, that's something you can expect. But then, of course, because of the new inclusions that, have a high tendency of disappointing investors, so when you net it out, your earnings are relatively weak. But nevertheless, if you look at this chart, which is something that I've constantly shown in my presentations, these are the regional equity performance of our ASEAN neighbors, not against US, okay, not against our European peers or Asia-Pac peers. This is against our ASEAN neighbors in US dollar terms. And if you can see which index is at the last, us, of course. So if you're a foreign investor and you were to invest, in US dollars, okay, in our markets since the end of 2013, after 9 years, what you'll be left with? Half your money. Half your money. Let's not compare with, your likes of NASDAQ, or even comparing with our regional neighbors, your likes of Indonesia, the likes of Philippines. We are far behind. Look at the disparity there. So, which is the reason why I do believe that, we are a laggard market, but, time and time again, we have to be patient. Because I do think that one day it could be our turn. But why like that? Now, if you look at the performance of various asset classes, I think lately the main talk of the town is recession. You ask people, what stock you're interested in, what stock is good to buy, what is good to invest in. Most commonly, you get, the common response that everyone give you is, hey, you crazy, you want to buy stock now? Recession is coming, hold cash better, which is my title, why I think the future belongs to the optimists. It's very difficult to time markets. We never, ever actually suggest or recommend our investors or prospective clients to try to time, the entry into the markets. I don't think anyone could do it accurately. Anyone who tell you they can, I think they are lying or delusional. But no one can. Okay. So if you look at it, since this chart shows that the performance of the various asset class since the start of COVID. So okay, the market did well. I think most of you, in this room actually saw how well the market did in 2020, right? 2020, even though, from a financial market standpoint, it's a great year, but, as a whole, in the real economy, it's not so good, because of the pandemic. But nevertheless, a lot of people made money in 2020. And then what happened? 2021 is a bad year for Malaysia. 2022, a bad year. What it's looking like right now is 2023 is going to be another bad year. 3 consecutively bad years. So sometimes I so feel bad. People start to ask me, why Malaysian market like that? I also say, I also don't know why people don't want to buy Malaysian market, right? Every year lose money. So if you look at this chart, right, the MSCI ASEAN index, okay, is actually trading at 20% below its pre-COVID levels. And if you look at the rest of the world, like MSCI Asia Pac, also slightly below pre-COVID levels. So that rally we've seen, all the returns have been given back already. The only place that was still very strong is the MSCI World. Why? Because the largest component is US stocks. Okay, this year, NASDAQ is up 30%, S&P is up 15%, the Philadelphia Semiconductor Index is up 40%. So what we can gather here is this. If you look at the S&P index and you strip off, your AI-related stocks, your large tech stocks, then performance of the S&P 500 is actually quite lackluster one. So essentially the strong performance that we have seen is because, strong push in technology counters. But again, in Malaysia, tech stocks, different story. But I'll show another chart later. Now, what can drive the performance of the KLCI index? So it being by default large caps, historically in the past, people keep saying that Malaysian stock market should trade at a premium one to our regional neighbors. Why? Because we got large institutional funds in Malaysia. So it's a captive market. So in a captive market, we always trade at premium valuation because this money had to stay here. Your likes of your EPF, your co-op, they will always reinvest in Malaysia. So, but that's no longer the case. As it stands right now, KLCI is trading at 13 times PE, forward PE, compared to its historical of 17 times PE. So we're no longer actually trading at a premium anymore. We're trading very close to our regional peers. I think Singapore is about 10 times PE, whereas the likes of your Indonesia, your likes of Philippines are trading at a significantly higher valuation. So we are no longer trading at a big premium to our regional neighbors already. And what can drive the Malaysian stock market higher, or at least the KLCI index? Foreign inflows. That's the only thing we can bang on. But as it stands right now, if you look at last 5 months, up to May, every single month foreigners are selling Malaysia. Last year, good year, foreign inflows was $1 billion US dollars. After 4 consecutive foreign outflows. This year, actually, if up to last Friday, the foreign outflow in Malaysian equities is about 4 billion. In last month itself, we saw 1.3, 1.4 billion of foreign outflows. So, for the KLCI to do well, you need foreigners to come in. Because our locals are not going to plow more money in. If they're in, they're already in. It doesn't seem like they're going to put more money in. So, from a large caps perspective, the big push will have to come from foreigners. So what can drive foreigners to come in? If you ask me, people can tell you all kind of things, but my honest opinion is all about a story. It's about stock price action. It's about how, FOMO, people keep telling you fear of missing out. You see the narratives of, different regional markets, right? There's always two sides of the story. If you look at how journalists write papers, right? An event can happen, and if the stock price goes up, they can explain it. Stock price come down, they can explain it on the same event. So basically, what will drive foreigners in is we need our market to actually start to be more vibrant. Last few years, you are slowly seeing the value traded coming down. I think this year, the average value traded a day is about 1.9 billion. Last few months, about 1.4 billion. During its 2020 height, right, the average value traded was what? It went all the way up to 4-5 billion. So what's that telling you? Investors are not putting money in the market. Local investors are not putting money in the market. Fund managers are not putting money in the market. And I can honestly tell you, when I speak to my peers, a lot of them, they are fearful. They are worried that the recession is coming. Now, I still think that there's a lot of money in this market right now. It's flush with liquidity. If you look at this chart right here, the US money market mutual fund total assets have actually been going up. It's standing at 5.5 trillion, even though US Feds have increased interest rates on the 10 times, 10 consecutive meetings. And why is it still, still at elevated levels? If you look at the chart on the right, US pandemic savings, right, is still significantly higher than where it was. Because, during the COVID period, the US government was just handing out free money to everyone. So this money, imagine this, as a US consumer, when you get the money from the government, you start spending it. The money just doesn't disappear. It actually moves around. So the multiplier effect of money have been flowing around the markets. So that's why I still think that there's abundance of liquidity in the markets. If you look at this one, okay, it's an asset allocation survey in the US. What we can see is the cash allocation is still at a relatively stable rate. It is at its normalized level at about 20-odd%. So, just now we saw money market mutual fund assets are at 5.5 trillion US dollars, at elevated levels. But actually, you look at it from an asset allocation standpoint, it's not like, they have started to hold 40-50% cash. So, there's just a lot of money in the market right now. It's not like, they are holding very little cash or so. So I personally feel that, there is opportunities, and where are the opportunities? So one area that we like right now is Malaysian tech stocks. Okay, it's a sector that everyone now is trying to stay away from. US Philadelphia Semiconductor Index, the SOEs index, since the end of 2020, as you can see, it's up 30%. This year, it's up 40%. Malaysia KL Tech Index, since the end of 2020, it's down about 12-13%. Whereas this year, we are down about 3%. So the disparity in the performance of the US tech stocks and Malaysian tech stocks have widened by a significant amount. And if you look at previously, there's a strong correlation between Malaysian tech stock and the Philadelphia Semiconductor Index. But now what we're seeing jaws here. The disparity have widened. So I truly believe that there is opportunity for the disparity to narrow. I do think that, the fear now everyone have when I speak to people is why they're not buying Malaysian tech stocks is mainly because earnings are going to be weak. A lot of people are telling me that, look, consensus expectations are still too high, there are more room to downgrades, which I agree. The thing with Malaysia is our sell-side analysts actually is a bit slow to downgrade the earnings. It's not because they don't know the earnings are coming down. It's mainly they don't want to offend the management of the companies that they cover. Because, you downgrade earnings of the company, then the boss come and tell you, hey, you like that next time, I don't want to tell you things anymore. So they know actually that the earnings was coming down. Actually, a lot of fund managers also actually know that earnings are coming down. So, but then on paper, on what people see, okay, they have yet to do the downgrades yet. But in US, it's very reflective. Okay, people do downgrade very quickly. And I do think that we are at the trough right now. I do think that in the second half, we are going to start to see, earnings picking up from a lower level. So essentially, when you invest in technology stocks, you're investing in the future. And the second driver is the weak ringgit. So again, exporters should do well. Ringgit is at what, 4.67 today, right? To the US dollars. The weak ringgit should drive the earnings of the exporters, something that we see in Japan earlier, I think. So I do believe that, Malaysia by default, of course, do we have the likes of NVIDIA here? No, we don't. It's, again, very cyclical. But then we do think that they will benefit simply because it's just cheaper to do it here, and the US and China tensions. So right now, because of the US and China tensions, tech companies are actually moving out facilities, to other places. And Malaysia being such a small country, all we need is just to take a small chunk, from the Chinese companies. That will do. So it's simply, we are just benefiting from the trade reallocations. So that's why we are investing in a few companies that we think would benefit from this, where they are, transferring the production from China to Malaysia. And if you look at it, obviously, yes, there are the larger tech companies who are reporting weaker profits, but there are also some smaller ones that are still actually delivering the earnings that everyone is expecting. They are actually still growing. So, as a stock picker, these are a few things that we look at. And then another area or sector that we actually like is energy. It's a sector that is, now everyone keep talking about ESG. Everyone say that, crude oil is bad. If you really think about it, we are actually, crude oil, yes, it's dirty, but natural gas is not. Natural gas is one of the cleanest form of energy. And this is actually one area we like. And actually for Malaysians, we cannot really hate energy. We really depend on Petronas, So even though people say energy is bad, we say no, we disagree. By default, if you look at Malaysian energy sector, this year Malaysian energy sector is up only about 2 percentage points. But why I like this sector? Several reasons to it. First, the monsoon is over. Okay, I'm not going to tell you that these are companies that I invest in, these oil companies that I invest in, it's going to have multi-year earnings growth. No. What I'm seeing right now is monsoon is over, the next few quarters should be strong for Malaysian energy companies. And if you follow Bursa announcements lately, you are starting to see that there are a lot more contract awards for these oil and gas services companies in Malaysia. Petronas have indicated in their Petronas Outlook report where they're going to increase these capex from about 40 over billion a year to about 60 billion now for the next 5 years a year. Now you look at it from domestic standpoint, okay, if you strip out the offshore one, okay, look at only from a domestic standpoint, we're looking at about 22 odd billion a year, which is about, not that much, but still about 6% growth from its previous years. So this is one of the areas where we are still actually seeing earnings growth, the energy sector. And if you really sit down, it's not too difficult. Look at all the other sectors, okay? Property sector, is the earnings growing? No. Construction, is the earnings growing? No. Plantation, is the earnings growing from last year? No. So if you really break it down and look at all these sectors in Malaysia, most sectors in Malaysia are actually showing earnings contraction. Whereas energy is one of the areas that actually will deliver earnings growth this year. So this is not a stock. People tell me 2050, no more already, oil and gas, Yeah, that's 2050. Today is 2023. I don't intend to invest in these companies and hold for 25 years, right? So for us, we are active fund managers. Maybe 6 months down the road, you come and talk to me, I may no longer have any energy stocks in my portfolio anymore. But at this juncture, I like it because I think earnings will come in. I think there will be contract awards. And I think that this is one area that investors have shunned. Because how do you determine whether investors have shunned this sector? Valuation. There are several companies that were invested in, trading at single-digit PE. You know, in Malaysia, single-digit PE. I think if any of you were to invest in Malaysian equity markets, I think you all agree with me. This is one sector that no one really looks at it anymore. The sector that people have been, talking about a lot was always the tech sector because of the strong earnings growth. But we think that, the valuation here is very attractive. And if next 2 quarters you're going to see strong earnings, I think my downside risk is relatively low. But I'm not going to tell you I guarantee we'll make money. No such thing in this market, okay? So essentially, I look at it when I were to make any investment, whether it's small cap, large caps, we always look at what is our potential downside, Is it worthwhile for us to make such an investment? Oh yeah, so yeah, I also wanted to mention. So another thing is the Saudis, right, need the oil prices to stay strong. Now, if you look at this, where it stands right now at $70 odd, I think it's highly unlikely for oil prices to drop further. They recently just mentioned that they're going to extend the 1 million barrel cuts a day. And I think that why they need to do well, because, if you're spending so much money, on other economic developments and on your football clubs. I think if you all monitor football clubs, actually sports itself, they spend so much money on live golf, buying up golfers, paying them ridiculous amount of money. They're now paying footballers ridiculous amount of money because they want to, they know they cannot be so dependent on oil forever. So, but then to fund all these expenditures, that probably will not return anything to them in the near term, they will need oil prices to stay strong. And being one of the largest oil producers, I think they will make whatever it takes, do whatever it takes to actually keep prices strong. So I think from an oil price standpoint, the downside risk is also relatively low. Now, this is also one of the reasons why valuations have expanded so much over the years. When the Fed was printing money and just handing out cash to everyone, right? But then that's changing right now. We have been talking about QE in the past. Now it's all about QT. The Fed is tightening. The US economy is, they're trying their best, to suppress the US economy. But why is that not translating to slower growth right now? You see interest rate gone up so much to what? Now 5 to 5.25%, the Fed funds rate. And based on the recent job report, it seems like it's going to go up another 25 basis points in the upcoming meeting. People are expecting after that another 25 basis points. So why at interest rate at such high levels, the US economy is not still slowing down yet? It's because when interest rates were extremely low, a lot of Americans actually refinance and went into fixed interest payments. So they lock in their low interest rate. Because think about it, when interest rate was at 0%, logically you would refinance your house and try to lock in at the lowest possible rate, right? Because it cannot go lower than 0%. Hence why it's not translating to higher mortgage payments yet. If Malaysia, if interest rate gone up to 6-7%, I tell you, the economy gone. How many people can actually afford to pay their car loans, house loans? But because in US, they actually refinance it. That's why it's not trickling down to the economy yet. And number two, the wage growth is still extremely strong. Why? Because over the years, the segment that didn't do well was the likes of the B40. And what the likes of B40 do? The services industry. And what we're seeing in the last few years is when, COVID went away and, the whole market started to reopen, people need to hire, restaurant workers, people working in the hotels. So it's this segment, the services sector, that is seeing strong wage growth right now. And which explains why, it will take some time. But when your interest rate goes so quickly, it will eventually hit them. So I do believe that eventually the US Feds will have to stop increasing interest rate. And that could be one of the catalysts for the Malaysian tech sector. So somehow, Malaysian investors, we would always like to see the thing come true first and not anticipate. So maybe that could be one of the catalysts when US actually stop increasing interest rate. Because in the last few years, people have, been trading tech stocks as like to bet against interest rate increases. So as the opposite were to happen, we do anticipate that, Malaysian tech stocks may start to do better. That's one of the catalysts that we think. And then furthermore, if you look at the 10-year rate of US 10 years at about 4% compared to the Fed fund rate of 5%. So what does that tell you? Actually, basically the market is telling you that eventually these high rates are not sustainable. They will have to eventually cut rates, which is a view that we have too. Now, this is one of the funds that I manage, CAF Tactical Fund. And this is the performance of CAF Vision Fund, one of the funds recommended by Fund Supermart. We focus predominantly on small and mid caps. If you look at the performance of the fund, it's up 122% since the end of December 2018, compared to 34% of the FPM small caps. So you see, you cannot buy the small cap ETF, right? There's no small cap ETF in Malaysia. And if you want to have a proxy or you want to invest in Malaysian small caps, you either have to do it yourself and start, stop picking one by one. But because it by default is being small caps, usually elect analyst coverage. So if you want to buy a basket of small caps, the only way to do it is to actually invest in a small cap mutual fund. And that's something we offer. And we have shown time and time again, we have proven that we can outperform the markets. And we have done well actually in the last few years. I mean, if you look at our performance speaks for itself. So we think that there are still a lot of opportunities in the small cap space. And if you really think about it, because by default, small caps is small. You're talking companies like what, 200-300 million market cap, right? Compared to something that's 6-7 billion. A small event, an event that can be independent to the company itself, can actually benefit the company. But for the likes of Maybank, there's unlikely there's any independent event that can actually change Maybank's profitably by a large amount. Whereas a small caps, all they have to do is win one contract, from a US supplier, and you can see earnings quadruple. These are things that can happen in the small cap space. But nevertheless, there's also a lot of risk investing in small caps. That's why, every day, us as fund managers, what we do is we constantly look for opportunities. We scour through all the quarterly announcements, try to go meet management, try to understand what's happening. And then we have a better picture. Okay, what is doing well and what's not doing well. Then we start to see. Sometimes we drive all the way to Penang or the outskirts. Like Kedah, to see companies, to understand what they're doing. So that's what we're doing. That's what we have been doing, and it has been translating to our outperformance in the past few years. So I think I would like to conclude my presentation today. I think later we have the one more session, right, to discuss. I think if anyone have any questions, you all can start to post there. Thank you very much.
Thank you, Mr. Tan, for such an interesting and insightful sharing. If you have any questions, yes, please feel free to post it as Slido, and we will address it during the panel discussion session. So, moving on, before we move on, I'd like to make some announcement, a quick announcement. First, we have this Q&A session will be conducted via Slido. And then we have live quizzes conducted through Menti. They will drop down randomly throughout our event. And then we have also, early, if you're not one of the early birds, don't worry, we will have a promotion with only 0.5% sales charge on the recommended funds. So, ladies and gentlemen, now we'll take a 1-hour break. For those live stream viewers, we'll take a 30-minute break. Sorry about that. And we'll see you back at 4:15 for those live stream viewers. So we have an exciting lineup of sessions and activities planned for the event. So Ladies and gentlemen, welcome back. It looks like you enjoyed the session just now, as I have seen many of queries about Malaysian equities. But fret not, we have more an interesting and exciting session moving on. So please be seated as we are about to start soon. So allow me to introduce our next speaker, Mrs. Penny Leong from Allianz Global Investors, Investment Manager of Manulife's Target Fund. Ms. Leong is the Vice President of the Retail Distribution for the Southeast Asia Division. Ms. Leong has more than 19 years of experience in retail sales and marketing. She is responsible for handling the relationships and business development with various business partners in Southeast Asia, particularly Malaysia. And today, she will be sharing with us a presentation on how to discover themes in a world of constant disruptions. Let's give a warm welcome to Mrs. Penny Leong.
Good evening, everyone. I was told that they always say save the best for last. I'm the last speaker, so I hope it is the best for today. Thank you so much for staying back. I know it's been a long day for everyone, and it's on a Saturday. So today, I'm not going to take too much of your time. I know I am standing between you and shopping in 1U and contributing to Malaysia economy. I will make it very short and sweet, and I hope I manage to deliver what I need to deliver today. What I'm talking about is going to be thematic investing and how you can actually capture today's opportunity with thematic investing. So this is very different from what you always hear, and I'm a speaker that is going to be on the same panel with all those fundamental fund manager, right? So I'm slightly different, where you don't really look at just fundamentals, but there's a new way to invest, also called a new way or new themes to this opportunity, and how you can invest through thematic to capture what is happening in the market right now. First is to give you a recap of 2022 global equity. I think to summarize or to sum up one word, whatever presumption that we made in 2022, I think it was just one word, wrong. Correct? It was talk about inflation should be quite transitory, but it was very sticky until now. And people were talking about rates wouldn't go very high, but we had the fastest rate hike we have ever seen in a long time, and in a very big fashion. And of course, some of them, as we really think that the global supply chain was affected, China was in zero COVID policy until early this year or end of last year itself. So all these things have actually, in a way, contributed to so-called a near-perfect storm in 2022. Now, I must assume, I've seen some of you here are more experienced than I do. You have not seen what you have seen in 2022 in many years of your previous investing experience, correct? When you invested in bond last year, also in the rate. Invested in equity, also in the rate. That's very rare. That's something you don't really see often. So what is it this year is, what are we looking at in 2023 for thematic investing? Now, really some of the, what has happened, the shift in 2021 to in 2022, the shift in the market where you have a rotation. You can see a growth value rotation from those performer to non-performer in 2021, 2022 is also very challenging for thematic investing. Now, I'm not giving you a so-called investment that will defy gravity, but something that will be more relevant in the changing world right now. I mean, the world is really changing. If you look around us, our young generation are always on cloud. They are always on social media. Even the older generation have to learn how to be on social media. How many of you have an IG account here? Very good. I see some of you are more experienced, even also having IG account. I thought it would be the younger one. They always say, yeah, Facebook is for the older generation, IG is for the younger generation. But I see some of you are in the older generation but still having an IG account. Good job. So for us, is really, I think, some themes have definitely cannot escape what has happened in last year. But to us, is because it's an actively managed multi-theme, then it is very relevant for the existing market right now. And of course, looking into 2023, now we are looking at some tailwinds from the slowdown in inflation. I think most of the fund manager will have told you that we have so-called seen the peak inflation, and Fed could be increasing interest rates some more, but at a slower pace, and they are at the tail end already of their interest rate hike. So that's why I think mainly also last 1-2 year, or especially last year, is very important where the winners and the losers, very clear cut, who are the winners, who are the losers, that has actually come out in those portfolio and in that kind of environment. So that's why we think that if you invest in multi-themes and themes that you can even relate to, I don't need to go through the portfolio or go through, you know what is PE, you know what is their next 12 months earnings, NTE, and all those with you. But I will give you some themes that you can definitely relate to. So that's really the changing world. And actively managed, where themes will be changed according to the environment. It is not just a fund on fund or theme will be forever there. That is an actively managed portfolio, which I think it makes perfect sense. Now, why has this thematic investing has become quite interesting to a lot of investors, and it's relevant? It is because of this mega trend shift that we are seeing right now, or we have already seen, and how you can, as an investor, you are investing, you would like to know that there's a shift in those mega trends and how you can invest and to actually make money for your portfolio, right? You're investing for money, for making profit and all, right? So what are the mega trends that we have observed? I can tell you, many people can give me a lot of mega trends, but let's put it into just 4 mega trends that's very quick and simple. First is urbanization. People are just staying more in the city, which we agree. If you go to Mount Kara, every corner is condo, and they are not letting go of every piece of land. Agree? Even in Subang, in everywhere, urbanization, everyone's just moving to a city, urbanization. Technological innovation, there's more robots. I think in terms of automation, there are certain things are just being taken by robots and you don't need human. Resource scarcity, we all know there are certain resources on this planet is finite, like water and all this, you cannot replace. And also demographic and social change, we have already seen that. Even in Malaysia, we are moving into the aging population, correct? And Japan is the aging population. China itself is also moving towards that direction because people are not having children as many as they used to be during my grandmother's time because it's costly, and you know now it's also because of the lifestyle, not easy to have children like many years ago. So that's also some change. So as an investor, I've told you about very big jargon, you know, like megatrends, thematic investing. How does that translate to you as an investor to invest? Let's say, yeah, I agree with megatrend, demographic change and all, but how does it translate to you in your portfolio? Very simple. Now, megatrends are very, very vague. So big, like megatrends, like demographic and social change. Anything you also can relate to demographic and social change, right? But how do we derive that? Then you move into a theme. Now, do you know from the megatrend of demographic and social change, there is a theme called pet economy. Wow. You can invest in something that's pet economy. And how in that pet economy, yeah, okay, pet economy, do you see people, anyone stays in Desa Park City? Around there? No? Anyone has a pet? Yes. Okay? You should go to Desa Park City because minimum entry is to have a pet. Okay? Because every time I go there, I see a lot of pet. If I don't have pet, I feel that I'm out of place, right? So in that megatrend of demographic and social change, people tend to have pet now, the older generation, because empty nest, people will have pet to keep them company. And with the pandemic, when you're locked down at home, a lot of people actually had pets. Second thing, also the younger generation, before they have children, they want to take care, they want to have a pet first to make sure that, oh, they can take care of so-called life being before they have children. That's actually the demographic change that has caused this phenomenon called pet economy. And within the pet economy, then what are the topics that you can talk about? Pet food, health, and insurance. Do you know that pet owners are very particular about their pet food? No, not longer my grandmother's day, they eat leftover. No. Now pets cannot eat leftover. Huh? They eat something that's maybe sometimes better than we organic food, full organic. So that's very different, and that is an opportunity for you as an investor. Next, so to show you that a thematic, multi-theme investment can also be active. It doesn't need to be passive. A lot of people think that, multi-theme, they just buy a few funds, fund on fund, then there's multi-thematic. No, it is actively managed. And the portfolio will move in and out of different themes that have already been non-relevant, or maybe sometimes the portfolio manager think that, we make a mistake coming into the theme too early, or that theme is at the end of the cycle. So these are things that's very important for multi-thematic investing. You need to be active. You cannot be passive. Next is some of the themes that I will share with you, and I think you will agree with me because I'm the last speaker and I'm the best. I'm just joking. So, okay, some of the theme is like infrastructure. You've heard of infrastructure. Do you know that in US, the so-called, I give it a very simple layman. The infrastructure department gave out so-called a report card in US. Do you know what they scored? You know, like A, B, C, D, everybody knows, right? So A is, of course, the best, Okay, A, B, C, D. They scored, what do you think they scored, the infrastructure in US itself? D. That means there's a lot of infrastructure, in a way, in US, that part needs to be improved, okay? Now, when we talk about infrastructure, a lot of people will think of companies like airports, they will think about companies like highways and all these things, but it is the value chain. The supply chain of the infrastructure, where you talk about raw materials, companies in terms of machineries and all. It doesn't just need to be airports, or it doesn't need to be all those toll company. It is all those supply chain to improve infrastructure. And as I mentioned, even in US, the infrastructure system scores D. So I know in KL, every day we see new roads, because yesterday I can go in here, but today is one-way street, right? So it is also improving our infrastructure. And Malaysia, I think for a lot of people who travel here, we have highway that's up in the air. It's getting higher and higher, right? So these are all changing of infrastructure and all. And this theme, I think, is very relevant because even in developed countries, they need to improve their infrastructure system. It is time to improve it. Or it's time to actually, they need to do some work on it, maintenance. Next is energy of the future. Now, this is to invest in cleaner energy and also efficient energy. Now, everybody is talking about clean energy, right? Anyone has an EV? Looking to buy an EV? Hybrid? Okay, now, but a lot of EV cars are already coming into Malaysia, and I think more Malaysians are more open to having EV cars, whether they are young generation, older generation. Now, cleaner energy and all, it is sustainable, all those energy consumption, it's not just about Malaysia, it's the whole world is talking about this, right? Clean energy, CO2. I find it very funny when we have colleagues traveling from Europe to Asia. Actually, I saw in their so-called traveling itinerary, there's like CO2 emission. I was like, what's that? Do you know that we actually track like CO2 emission when you're traveling and all? We are actually encouraged not to really travel so that we don't contribute to the CO2 emission by taking airplane. So that's why Zoom, Teams meeting is all. So this is actually not only in countries, but in the world. Everyone is talking about clean energy. Next is clean water and land. This is talking about water quality. Water is water scarcity, as in we cannot replace what we have. That's all we have means we have. We've got to use it efficiently. Malaysia is very, very blessed. We don't need to worry about water. You turn on the tap while you're brushing your teeth, 15 minutes, you can turn on the tap, the water running. Actually, that's not encouraged. But, in some countries, in other countries in the European country or Eastern European country, that they only can water plant at certain hours. You cannot wash your cars every day. You only can wash once a week or something. These are the things that water scarcity and also the quality of water. last year, I think we always have water cut, right, in Selangor, Ice Selangor, all those things. So these are also important, where one of the themes that will actually resonate very well. I see a lot of people nodding, and maybe you're affected by the water cut, all this is very important, yeah? So I think how many times in KL? 11 times last year or something. Also, many, very, 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 very common. And now that we have to think of water usage, efficiency in what you are going to recycle your water and disposable and all these things, yeah? Next is digital life. In digital life, we look at, I think one that is very, very common is digital finance and cyber security in digital life, right? They call it simple layman Cantonese. Anyone play online game? Oh. Wow, do you know that average online gamer is not 15, 16? I think it's 30 something. So don't be shy, you can put up your hand if you're a gamer. Now, anything you do, first thing you do, sit down, you're playing with your phone. I was like, what are they playing? Online game, right? Of course, then cyber security is one of them, digital finance. And also digital finance is a very big thing. I think slowly on and coming. Banks are going on digital, fintech and all those. Anyone uses, who do not use your e-wallet? Wow, only one, huh? So a lot of people use e-wallet now. Soon you will be converted. I never use e-wallet until MCO. You got no choice, right? So now, e-wallet. I can go out having just 20 ringgit in my wallet, but I got e-wallet. Okay, so fintech, I think that is also changing the landscape of banking. No longer just like you go to the bank. Last time we would like to queue up, pay your bills, see your banker. Now bankers also don't really want to see you, make your appointment. And during MCO, how to see your banker? You want to invest unit trust? Sign up online, right? Everything is done, fintech, all these things. And of course, with that is cyber security, right? Do you have phishing email? Do you have very suspicious email? Now that anytime email, I don't know this person, delete. Right? Don't even dare to open. So cybersecurity is because we are all on social media, we are always online. Right? So who will be always online? Everyone, right? Who will go offline? When you go offline, everybody panic already. Hey, what happened to you? Start calling you. Why are you not online, right? So cybersecurity is also important. That's in digital life. These are one of the things that I think fintech and also cybersecurity. And again, health technology, do you know that, this is in companies that invest into technological improvement in healthcare. Healthcare is a very, very big industry, and it's very regulated. Even to have all this tech into healthcare, it will take time, right? Imagine healthcare and all those uses AI, where now imaging like X-ray, you don't really need doctor to look at your X-ray, just AI imaging. They will pick up very simple things like cancer. They will pick up certain things like diabetes. Very, very simple things that you can save a lot of the doctor's time in that sense. And I think going forward, more and more into technological improvement will be very useful in terms of the healthcare industry. But it's not going to happen overnight. It will take time because it's very highly regulated industry in that sense. Next is intelligent machine. This is something that we added on, I think, or we saw a very relevant in 2022. Wow, the year passes so fast, I forgot what year we are in already. I thought that last year is 2021. So it's, I think, in 2022. Now, intelligent machine also targets or caters or added because of inflation. Inflation is a main thing now. You see restaurants now, shortage of workers and all. After pandemic, I thought that people would think that, hey, I need to work, I need money, like, pandemic that time. But it was the other way around. After pandemic, people realized I need to have more work-life balance. Those dangerous jobs, I'd rather not do, So that's why people need to look for workers. You always have shortage of workers you see in cafes and all those things. That's why I think certain jobs will be taken by robots, automation. It's also, in a way, will help in wage inflation because I have machines to do it. I don't need to have human to do it and then I have to pay more for it. I was just joking with people like on intelligent machine or even on wage inflation. I truly, truly can relate because I was walking one day in a cafe in Mount Kiara and they said they were closed during dinner time. That means they close the cafe at 7 p.m. Dinner time at that area cafe, it should be quite good business, right? But they are closed because shortage of staff. So imagine even wage inflation is a kind of inflation. And that's why I think that also gave a rise to intelligent machines where you have automation, robots to do certain very simple job like stacking of stuff and all those. That you can actually invest using automation. And that has, in a way, with the pandemic, and also has caused that rise in terms of investment into automation. Next is, I shall not tell you, this is one of my favorite theme, very easily relatable, pet economy. Now this theme actually, as I shared with you just now, companies that provide products and services and pets and other things that are, and other animals and all. Do you know pet economy is growing at a healthy and I think high single digit in US, and I think in countries like China and all, it's about double digit. They are saying that, you know, they have more pets in China than human. That's one thing. Like people now, because people, there's a phrase called humanization of pets. Now pets is no longer pets, they are family member, right? You have name for your pet already. You don't call it like last time my grandmother just called dog or some Chinese name. But now they have pets, kittens, cats, and all those. They have names and all because they are part of their family members. So also this have really important is during pandemic lockdown, people actually adopted a pet. They decided to have a pet. And recently I spoke to my neighbor. I said, hey, that day I went to your house, you have a very big cat. That's the biggest breed cat. I would say quite scary cat, but it's quite cute, but it looks scary because it's big. Say, oh, why did you decide to get a cat when you have three daughters already running around, the three daughters? That's because of pandemic law, nothing to do, go and buy a pet, and now the pet is stuck for life. So you know that pandemic has also caused a rise in pet adoption, and that people don't throw out their pets. Come on, they keep their pets. So we also actually did a survey and asked, like, after the pandemic, does people love their pets still, or they're going to give up their pets? And you'll be surprised that a lot of people say that after pandemic, they still love their pet. They keep their pet as family member, and some will say that they will celebrate their pet's birthday every year. Got pet's birthday party. So minimum entry is another pet for the party, right? So that's why I think this is a really a theme that's not only in European country or in the Western country, it is also catching face in Asia. As I said, if you don't believe me, just go to Desa Park City. Minimum entry is you must have a pet. Then you see everyone has a pet. And even the restaurant have to cater to those with pets where they have outdoor dining. Al fresco, right? Because they will bring their pet and they will dine in the restaurant. So that's actually what I have to show you on some of the theme. And I think thematic investing, multi-thematic investing, really makes sense in the changing world right now. No longer we have a line of this company does car maker, this company is maybe a car maker or technology IT company. It's a very blurred line already, like Tesla, car company or tech company, it doesn't matter. So this is where you look at different themes that will make sense in the ever-changing world right now. We are in a very, very much changing world right now. And you just go for themes that you think, that you see, and it will make sense to you. And all these themes is not hidden. You will definitely hear. I'm sure one of the questions later, I can foresee, is going to be ChatGPT, right? That's all talk about. So all these themes and all. People talk about pets, people talk about infrastructure, people talk about ChatGPT, people talk about AI, people talk about tech. So for you as an investor, it's very simple to relate to. And it doesn't take rocket science for you to actually understand what it is, right? So that's actually what I have to share. I know I am ahead of time because I am promoting Malaysia economy for you to go shopping later. So that's why I'm finishing a bit ahead of time. Thank you so much for your time, and I'll speak soon.
Thank you, Ms. Leong, but maybe just a moment, because since we have a later time here, maybe just one question. So among all of the teams that you mentioned just now, which is your favorite team?
My favorite team is the little cat wearing spectacles with love. That is pet economy, because I myself really see it living in Malaysia, and I think really pet economy or the pet nation is really picking up. I may not have a lot of pet owners here, but you know that those who have pet, you will not stinge on your pet. You rather stinge on yourself, but not your pet, especially pet food and pet healthcare, right? So that's one of my favorite teams. I do see the potential personally because I go around and I see that people more and more are having pets. So that's one of my favorite teams.
Okay, thank you, Ms. Young, for such an interesting sharing. So moving on, we will have the panel discussion session. But first of all, let us bring out the chairs and tables and coffee tables up the stage first. So while we were waiting, let me just make some simple announcement. So if you are not one of the early birds, no worries. We are still having a promotion with only 0.5% sales charge on the recommended funds. And to be eligible for the promotion, simply log into your FSMOne account and start your investing journey before 28 July of 2023 with terms and conditions applied. So next, feel free to talk to our FSMOne team if you have any interested in account opening or seeking investment ideas. You can talk to our client investment specialist. If you are keen to know more on our recommended products, recommended unit trust funds, or get more market insights, you can talk to our research team. And if you seek to know more on our managed portfolio, please approach our managed portfolio team. Or if you want to know more about our stocks and ETFs, we have a stocks team also. And any inquiries on bonds, please seek for our bond team, and we also have our insurance team waiting for you. Also, please do not forget that we have another session of lucky draw awaiting, and where we added some element of excitement throughout to our event today with a special lucky draw. And we have amazing prizes worth up to 1,500 ringgit Malaysia, worth of prizes to be won. And I'm thrilled to announce this fantastic opportunity to all of you. So, so for the panel discussion, ladies and gentlemen, so for the panel discussion, it will be, you can post your question up in Slido, and then our moderator will take the questions and start giving those questions towards our panelists. So ladies and gentlemen, we have arrived at our final panel discussion for the day, and led by our esteemed moderator. So this session will promises to be a thought-provoking discussion that will delve into various perspectives and ignite meaningful conversations. So without wasting any time, allow me to introduce our esteemed moderator for this session, Ms. Lim Chin Yen. So followed by our panelists for this session, Mr. Tan Ji Tun, Mr. Yap Chi Ken, Mr. Tan Gan Leong, and Ms. Penny Leong. Can we give a round of applause? And I'll pass the floor to you, Mrs. Lim.
Yeah, thanks Alvin, thanks our MC. So this is Chin Yen from FSMOne. I will be the moderator for today's panel discussion session. So I know it's a long day, but please refresh your mind as I do see some burning questions coming out from our audience. So now let's take a look on our Slido. So we do receive a couple of questions from our audience here. So now let's start with the country that a lot of people have asked about, which is China. So based on the latest news, right, if you notice some of the headline, China actually banned the export of some key important element in building the semiconductor, which is important for the sectors. So I would like to pose this question to Jitun, because one of the key investment team you mentioned about is semiconductor self-sufficiency. So will all this geopolitical tension, export ban, will impact the investment team significantly?
I think the way that I would think about this is, I think it's precisely because of the US-China tension. Then we will have this team called the China Self-Sufficiency Team. Because if you just rewind back the clock, 5 years ago, I think WTO ruled the world from the perspective that everything was all about efficiency, lowest cost, right? There's very, very little consideration given to geopolitical issues, talking about friendshoring, onshoring, reshoring, right? So I think it's precisely because of this US-China tension that we have this artificial restrictions being set up. And that's why China is going on this localization theme. And therefore, I think it's inevitable. In fact, from my perspective, I think for the foreseeable future, I think this US-China tension is here to stay. So the export restrictions on AI chips, export restrictions on the leading edge of semiconductor, this will be the new norm going forward. And I guess then the logical question to ask is, so what is the response from the China side? Right? So if you look at, from the China's perspective, there's been very little tit for tat. Meaning, I think this is the recent restriction on gallium and germanium is probably one of the rare instances that we have seen this happening. And even from my perspective, I think, these are minor metals. This is probably a starting point for negotiation, right? Because if you need to negotiate, you need to have coming from some point of strength, right? If there's no restrictions, then why are we negotiating? Because you are the only one beating me, right? So I do think that this is probably some political maneuvering as well. So going back to your questions, I do think that, like I said, technological restrictions is here to stay. And therefore, it's more important that we play the China localization team, because this is the only way China can break out of this vicious cycle. Okay?
Yeah,
Thanks.
I think exactly like what Jitun has mentioned, moving forward, it will be the new norms about all these export restrictions, but what we want to focus is on the potential of the sectors moving forward. So speaking about the tech sector, right, I do spot a question from audience as well, asking about Malaysia tech. So just now, Kan Leong, you mentioned about moving forward for the second half of this year, there could be catalysts like earning pickup for the tech sector that will close the divergence between US and Malaysia tech. So will this audience actually concerned about what if when the earning pick up, but US tech starting to see some pullback, will it pose a headwind for our tech sector despite the earning pickup?
Hello. Yeah. So, okay, basically from what we're looking at is most Malaysian investors are actually not plowing their investment into Malaysian tech sector, hence why the disparity is there. So in the event that, there is a correction in the US tech stocks, but, you're starting to see earnings to pick up in Malaysia, we think that the downside risk is relatively low because, again, you're starting at a lower base. So time and time again, if you look at the Malaysian market as a whole, a lot of times you see the US market's gone up quite a fair bit, right? I mean, this year, Nasdaq's up 30, S&P is up 15, whereas our Malaysian market is down about 7, right? So lately, when you see the US stock market start to correct a bit because they've gone up so much, you don't see much correction in the Malaysian market. It's still relatively lackluster. And how we look at it is, Malaysian market, you cannot just solely look at just on a return perspective because, again, there are always a lot of window dressing happening in Malaysia. So a lot of times, a lot of things are, in a way, it's made to look better. But what we look at is we look at how much value is traded every day in the Malaysian market. How's the participation like? And what we're seeing right now, it's at about 1.3, 1.4 billion every day. So that is very similar to the previous bear markets that we see in Malaysia. So at that juncture, we think that, a lot of funds are already very cautious at this standpoint in Malaysia, those Malaysian-centric funds. So we think the downside risk is relatively low. But then if the earnings were to start to come in, and again, the market have to start to, have to be a conducive environment as well, right? Because, we got state election coming up, we don't know how how's the political environment will be. But if the environment is still conducive, we do think that the stock price should reflect the earnings growth that we see.
Yeah, so it seems like Malaysia tech sector is also one of the area that investor can continue to, monitor and also take a look at the sectors. So we saw a follow-up question on the geopolitical tension that we discussed just now. So this question is posed to Chicken. So we saw there are more and more companies starting to build their factories, their plants in other Asia countries outside China, like India, Indonesia, right? So are we going to foresee all these other countries become the next manufacturing hub like China, and how long will it take for it to materialize?
Yeah, I think that is a trend we're going to see for years to come. And, as this global growth slows down, right, there will be impact on the global supply chains impacting the Asia. And within Asia itself, I think we're also seeing some rebalancings of this portfolio within the economies. That's why you can see, some of these economies start to look at other growth business model. So I think it's not really a bad thing. I think, because of the lockdown in China, everybody started to realize that, they're such a powerful house in terms of manufacturing. And I think they want to do away with that. And coming from the US, they always want to see that, de-risking from China is a key priority for them. So I think a lot of countries, in a way, they do not want to sort of offense both sides. So definitely you will see some of these outflow coming from China for some of the manufacturing activity moving away from China and have some, establishment in Asia. And I think in Malaysia, I think we also in one of the beneficiary of that particular trend. You can see some of these US companies start to actually build some of their manufacturing facility here in Malaysia, despite the fact that, we are start to have a lot of medicals or even like electronic devices that, be part of the global production change. So I think that is going to continue for a little while. And this is going to be a trend for years to come in Asia.
Yeah, I think this is also one of the key investment case for investing in Asia. So just now we've been talking about tech, which is the high growth sectors, right? So there's this audience curious about thematic investing. So it's not something that too traditional. So he would like to ask Penny, like, how different is this thematic investing compared to traditional investing, and why does it deserve a place in investor portfolio?
I think thematic investing is different compared to traditional. Where traditional, you're usually into country sector allocation and all. Theme is really, thematic is what we look for companies that's relevant to those themes and how you can actually participate in the changing themes that you already see in the market right now. I mean, if you look at something, if you see there's a theme or there's something like a pet economy, as I shared, or health tech and all. But you as an investor, how do you participate in that? With thematic investing, we put aside all those sector allocation, geographical allocation, but to those companies that will be relevant to those themes. And as investors, you definitely want to participate in those teams and those companies that will actually then again make sense to your portfolio. So that's something very different, and we are in a fast changing world right now. The world changed so much in the past 3 years in pandemic, really. And as investors, clearly, if you see something, you just want to participate on it and actually translate into profit or into your portfolio. So that's what I think.
Yeah, I think this is how thematic investing is positioning something new and different for investor to consider. So there is also a follow-up question for Penny because you mentioned about renewable energy is also one of the key themes within thematic investing. But it seems like there is a high entry barrier because you need to build the infrastructure before the company can turn profit. So how do you see about it? Does it take a long time to materialize?
Those next generation energy is really about, I think that has always been in the talk. But really, let's rewind and look back at last year. If last year, 2022, with the Russia and Ukraine tension, I think if you ask Europe, they will immediately say, we can have next generation energy now, immediately, because we don't want to rely on Russia for their gas and all those. And really, I remember my colleague was just saying that from Europe, it's going to be a cold winter. Whether we have gas or not sure. So that's also, I think, yes, it will take time for those companies to make money. I mean, even tech company, high growth, you invest in it, they may not be making money immediately. That will take some time. But I guess the theme is, the next generation energy theme is still relevant. It is not something you just talk about 1-2 years and then that's gone. It's going to be continuous. And we will take time. And there's also the Inflation Reduction Act in US where, they actually help those companies, or they give tax rebate to companies that goes into all this renewable and all these things. And I think that will catch up also in Europe. So I think, yes, maybe some of the companies may not make money now. They may take some time. But I would think that the theme on next generation energy will still be a talk globally everywhere. So that will be relevant.
Yeah, totally agree with you, Penny. So I think investment itself also should be more forward-looking. So instead of looking at current situation only. So speaking about renewable energy, clean energy. So just now, during Zichun's presentation, you mentioned about EV batteries, how Chinese companies, their dominance in terms of these sectors. So this audience would like to know about how about the front-end player, like those BYD, Tesla, because like Tesla, they have been slashing their margin, right? So does it mean that investors should focus more on the raw material, that kind of side?
Yeah, I think that's a very good question. I guess from my perspective, the answer is yes. It's easier to just focus on the supply chain. Like for example, I think during the gold rush, right? I think the guys who made the most money are the guys producing the jeans, the shovel, right? You know, they are the ones we know that in terms of volume, those guys, their volumes will go up. But are you going to pick the guys who is going to strike gold next? It's practically impossible, right? Especially when you come to things like consumer goods, right? You know, I think around all the audience here, like what I mentioned during my presentation, you know, some of us may have BM, some of us may have Nissan, some of us may have Toyota. So to each his own, right? So people are looking for different aspects when you comes to buying a car. Maybe somebody wants safety, somebody just like the design, somebody likes design. And my preference of design may be different from yours. You might like it cute, but I like it aggressive. So it's very hard. But at the end of the day, if we can find the common denominator, the common component that goes into all these cars, right? No matter who wins, I win, right? So this is how I think about it.
Yeah, so how about Chicken? Because during your presentation, you also mentioned about renewable energy within Asia, right? Do you share the same views as Jitun? And this audience also would want to know which country other than China to focus if they want to investing in renewable energy within Asia.
Okay, before I move on to that, I think I want to just quickly go back to the previous questions on, you know, some of these EV manufacturers. I think the competition, I mean, there's a lot of fierce competitions, you know, and recently, early this year, there was a price cut among the EV makers. But having said that, I think if you look at the size of in Asia, particularly in China, yeah, I think even though some of these EV new startup, right, they've been around for less than maybe 10 years, but having said that, I think you look at a company like BYD, because the market sizing, they've been able to really mass produce, and they're profitable right now. And not only that, there's some other like new startup, for example, Mr. Lee just talked about Li Auto. Yeah, I'm not sure, are you owning a share of it, Li Auto? Yeah, that company just recently happens to be, again, not only they break even, they're starting to make money. So we're going to see some of these very strong EV player will continue to emerge because that segment, the target market, the segment is different. So I would foresee other players, like for example, Xiaopeng or even a Neo, in a foreseeable near future, they probably be able to sort of like break even and start to make money. And this is good news because you can see the demand for the EV car, not only in China, but for the rest of the world. Yeah, so it's going to be very strong. And coming back to a question on the clean energy, which are the countries that are working on this? I think the next one I think we should focus on will be in India. India also have made commitment to actually really make it to build solar panel. I think on the solar manufacturing, they will continue to work on that. And for Korea, I think you can see just during my presentation, I think not only they want to make a better commitment to a clean environment, they also continue to do a lot of research and development in the hydrogen fuel cells for the car, for the EV car. So these are a lot of the opportunity we're seeing just within the Asia itself. So I think you're going to see some of these new startups start to really, really make it in the next, I wouldn't say next few years, but probably in the next decade. So I think this is the way I think at East Spring, we focus on the mega trend and we just constantly focus on that. I mean, the volatility can be a good opportunity for us as well to pick up some of the share at a really reasonable prices. I mean, you know, for example, I mean, just a few months ago, everybody thinks that, you know, China EV is going to be gone case, but you can see how fast they actually bounce back. I think just a couple of days ago, I think there was an announcement made by all these EV makers, even including Tesla, saying that, you know, they are agreeable as a group, right? They are not going to simply do a price cut or price war going forward. I think that, that commitment, I think, is huge. I think it's going to drive some of these EV makers, car makers, is going to be a greater height from this level. You can see a lot of the bounce back recently in the new startup like, you know, Xiaopeng, Neo, or Li Auto continue to have done well in the last few weeks.
Okay, thanks, Ken. So I also learned a new thing today. Like India is also one of the key players in terms of the solar panel, green energy. So let's see what are the questions that we have from the Slido. So one audience actually mentioned about the political uncertainty as one of the headwind when we do investment. So for example, in Malaysia, right, we are going to have state election as well. So is it one of the key reasons why we are seeing consistent foreign outflow on this year? And will the situation actually improve after the state election, Gan Leong?
Actually, if you look at the historical trend, right, time and time again, right before general election, right, the year before, actually foreigners actually like to invest in Malaysia because in anticipation there'll be a lot of contract announcement, a lot of goodies being handed out. But it seems like this time around, with this state election, the reaction is a bit different, where foreigners are quite concerned because obviously what we saw in the most recent general election, I think foreigners were very worried that we become, being tilted too much on the radical side of things. So I think foreigners always prefer countries to be a bit more neutral because neutral policies are good for investments. It's more stable. So I think that's one of the concerns they have. And this state election, two areas where foreigners actually, two key states like Penang and Selangor, right? I think foreigners, what they're looking at is whether the current ruling government will actually lose seats or not. Because this is actually an indication of the future. Because for most, you think about it from a foreign investment standpoint, why our ringgit is so weakening, why people are not investing, even though at 4.67, from a foreigner, from a foreign company, a multinational, for them to invest, they're looking at not just 1-2 year thing. They're looking at, okay, if I want to invest in Malaysia, if I'm going to set up a facility here, I'm going to start hiring hundreds or thousands of workers. I'm going to look at whether the next 5 years, whether it's political stability. So I think that's something that they are looking at, the trend. Whether it's actually moving, whether our current government, a ruling government, actually can hold on to what they have. If they can do well in this coming state election, I do believe that it should be a positive catalyst for our Malaysian market.
Yeah, I think this is the things that we might need to continue to monitor for its outcome. So since Gan Leong, you mentioned about the weakening ringgit, right? So this is one of the questions that we receive a lot from investors as well. Like ringgit has weakened a lot on this year. Actually, this other than the rally within US dollar, but the ringgit actually weakened more than the rally itself. So moving forward, what could be the headwind and the tailwinds maybe for ringgit to recover?
So, I think one of the reasons why ringgit is also weakening is because you see there's a huge disparity in the interest rates in Malaysia and the US. I mean against the US dollars, right? US interest rates are going at 5% to 5.25, whereas our OPR is at 3%. So there's actually not just a small gap. We're talking about 2 over percentage point. And if you look at it on a historical basis, right, time and time again, right, Malaysian interest rate is always higher than the US interest rates. So this time around is a bit different. Why? Because we don't have the inflation problem. So we don't really need to actually increase interest rate at the pace that US needs to. But if you look at it from a real interest rate standpoint, actually Malaysia is okay. Well, because we don't have an inflation problem. Whereas US real interest rate is only starting to actually turn positive because, they had very high inflation rates. So I do believe that once the US Feds were to stop raising interest rates, we should start to see a bit more positive push for the ringgit. That's my personal view.
Yeah, I think this is a relieving news for Malaysian investor on the potential recovery of our ringgit. So seeing some of these questions from Slido, we do receive a question about China. Because we have the SOE reform in China, right? And looking at the market performance on the onshore is mainly really driven by the SOE. So when it comes to valuation, will it be going at a high valuation level for investor to enter now for the SOE? Jitan?
I think the short answer is no, because SOE has traditionally been trading at a huge discount to the market. So typically over the course of the last 2 decades, SOEs in general, with a lot of, government-linked companies all over the world, I think it's inevitable that to a certain extent they have to do a bit of national service, right? So be it in the power sector, steel sector, banking sector, we all understand that when the country's in trouble, SOEs come in and they try to save the day, right? So that has always been the case. So that's why SOE in general has been trading at a massive discount relative to the private sector. Like for example, SOE banks in China trading at 0.3, 0.4 times price to book, whereas the private sector banks in China are trading at 1.2 times price to book. Okay, the reason I think it's justifiable because ROE or return on equity between these two types of banks is very, very different. So as long as we are seeing improvement from the SOE perspective, we are not even trying to say that it will re-rate to the levels that we see for the non-SOE companies. So as long as there's some improvement, I think there's a lot of potential upside to be made in this sector, right? So this is very, very nascent. I think it's only within the last 2 to 3 months that investors, even like myself, are starting to take note on this. And having said that, I do think that the road to SOE reform is very, very long and it's going to be very, very bumpy, right? SOE in most countries typically hire a lot of people. The people running SOE has been government civil servants for the longest time, with probably backing informally or formally from different segments of the political establishment. So it's very, very tough to do actual SOE reforms. But nevertheless, so at least I think Chinese central government is well aware of that, and they are pushing through all these reforms. So I think that's a light at the end of the tunnel for a lot of these companies.
Yeah, just a follow-up question from myself, right?
Sure.
So within your the portfolio by RHB, right? Like how much of it is into SOE? Is it close to half of the portfolio?
No, very much less than that. So roughly speaking, roughly about 20% of our companies are SOE related. And I guess I just want to highlight that SOE is not the only theme that we buy in. So when we buy a company, we want to have multiple so-called engines going for it, right? It could be, I like it because it's linked to the growth sector, or it's linked to the energy sector, it's linked to the consumer sector. But on the other hand, if they are backed by SOE, then that's another engine for it to do even better. So typically the percentage of companies that we have in the portfolio that are SOE, most of them are in the energy sector, which obviously makes sense. A lot of them are in the financial sector, and last but not least, quite a few of them are in the utilities or the power sectors as well. So these are the high quality ones which we think we're very familiar with the management. We're monitoring them for a long time. A lot of times over the last decade or so, their hands are tied because it's national service. They can't say no, right? So right now, with a new set of policies on hand, then they can use that policy to push back, right? So we do think that there, like I said earlier, I think there's light at the end of the tunnel for a lot of these good SOE companies.
Yeah, thanks, Jitun. I think despite the growth potential, right, it's also very important to have a diversified portfolio to capture on the growth of the segment. So other than the political uncertainty, the policy support by the government, right, some of the audience also concerned about the recessionary risk. So Penny, you mentioned about thematic investing is actually different from the traditional. So can we safe to say that it's actually recession proof when we do thematic investing?
Okay. No, definitely. You can only maneuver to some themes that would be relevant. It cannot defy gravity, like just in 2022, 2021, it was when there was a rotation. So, but the thing is, at least you're looking at themes longer term, and that would actually, when market behave a bit normally, like this year, 2023, I think then thematic investing, and you look at the themes are still there since last year. So if you really go into a recession, I think a lot of data, I'm not sure about fund manager, but from, I think a lot of data saying that it could be just a soft landing or a quick one for US going into recession in that sense. Now that's really data dependent, right? So I think the portfolio definitely, if it's going to be an equity and all, it's not going to defy gravity. But the thing is, it's more skewed towards a core, it came down from a more growthy numbers to a bit more core. And if you look at the 7 themes that's in the portfolio, some of them really are relevant, like pet economy has been quite resilient. Infrastructure, that's something that you'll keep on going. Even it's recession, you still need to, improve your infrastructure. You still need to maintain that. Water and all those companies, water theme, it will be continuous. It will definitely not defy gravity. If you have, growth and you have got a hard landing in US, recession and all those, I think there will definitely be a bit of drawdown. But at least if it's going to be a soft one or not a hard landing, that will pull on. I would think that it will hold up quite okay. If you look at to the whole portfolio itself, it's more towards core, not so much into growth. So it depends. Again, an equity portfolio will never defy recessionary kind of risk, But at least the theme going forward, it makes sense. And at the moment, the 7 themes, I would think do quite okay in a soft landing kind of environment.
Yeah.
Maybe I can just jump in, just echo
Sure.
what Penny said. So I think I know there's a lot of concerns out there about recession and all that, but I think it still depends on your perspective, right? So if I don't have the theme, I don't have the stock, then if the recession comes and the share prices go down, then it gives us more opportunity for us to buy into that theme that Penny's talking about, or theme that the investors here are looking at. Maybe these themes are expensive now, but if something hits and the market goes down, then it gives us another bite of the cherry. So once again, I think it's a matter of perspective. It doesn't mean that recession, we should be fearful about that. A lot of it is also about, like what you mentioned earlier, having a diversified portfolio, right? And also being active about which themes that you should go in and identifying good themes that can stand the test of time. I think that's going to be very useful in terms of when you invest a portfolio and you invest for long term into your retirement.
Yeah, I think the key is to focus on the quality of your investment, to focus more on the quality side itself. So Ken, we would like to also know about, because when we talk about recession, mostly now people are talking about developed market, right? Like US, Europe. So how about the outlook for Asia? Is it not going to have a recession like people have been talking about for US and Europe, because our central bank in Asia is not hiking rate as aggressive like the developed country central bank?
Good questions. You just look around in Malaysia here. Coming here from Shah Alam, I'm taking the NKVA plus the LDP. Am I seeing recessions? I don't think so. I think everybody's going out to have a good time, right? I think Asia is slightly different from the rest of the Western country, because I think they've been impacted really by the war, as well as some of these geopolitical concerns. But in general, we don't have the sort of inflation in Asia. So I think there's no need for the policymaker to react like what the Federal Reserve is doing. I mean, I have never seen in my lifetime a Federal Reserve actually hiking the interest rate in such a steep manner. I mean, usually, in the last couple of financial crises, they've been quite steady. Every time they want to increase, I am telling you, 25 basis points each step of the way. But look at the rate hike this time around. It is not 25 basis points. It's not going to be that. So coming back to your question, yes, inflation is an issue in some of the selected Asian countries, but is not as severe as some of the Western countries like UK and US. So having said that, I think, of course, being a fund manager, we are not so lucky because in recession, you can just withdraw your money and put everything in the cash, right? And we managing a fund, I mean, what can we do? I mean, if you're running a relative return portfolio, you have to buy something, right? Of course, there are some risk management strategy or technique that we are using. For example, like what Mr. Tan said, I think you have to be really focused on the quality of the stock that you are selecting. I mean, in Asia, there are a lot of good quality growth company, Now, holding them during the tough time, I think you just have to bear with it. Even though they may not drop as much as those small cap or mid cap. So I think in Asia, I think there are enough country, enough economy, and the universe is big enough for you actually to weather that sort of environment in recessions. So I mean, what we are doing right now, of course, really if the recession comes, right, I mean, the portfolio we run is basically the Asia Pac. I think if you look at this part of the region, I think there are a lot of good dividend yielding stock with good cash flow, with good quality growth. I think these are the focus of our investment strategy if the recession really comes. Now, of course, we will hold a bit more cash, but you know, we wouldn't hold like 50, 60%. That is really, really bad, because what if we get the thing wrong and market just rebounds? You know, I mean, this day the rebound is scary, right? It's not going to be like very slow and gradual. It's going to be a V-shaped rebound. So if you are not invested, you will be caught. And then when you are underperformed, you will be blamed. So yeah, it's not an easy answer to that question, but I think by and large, I think most of the fund managers do have that strategy to defend if recession is really coming.
Maybe I could also just jump in. So as I guess in my position as a regional CIO, so the good thing about ASEAN is, or Asia, in fact, is 10 countries, 10 economies, 10 currencies. And in a lot of ASEAN countries, like I just want to paraphrase what Penny said. You know, even though we can't defy gravity, because if let's say market is down, I think we will go down together. But the good thing about Asia is our pace of economic growth is very different across the board. We have the lights of the more advanced economy, obviously Singapore, Japan, Korea. You know, so those guys are very linked to the US, like what I showed in my charts earlier, or rather very linked to the developed markets. But if you look at our part of the world, ASEAN in general, right? Thailand, Indonesia, Malaysia, a lot of the economies are a lot more insular, right? So even though developed market is going to struggle, but if you can move money around, like what Ken said, to countries or economies that are less affected, I think they will be a bit more resilient, even though we may see an overall growth slowdown.
Okay, so speaking about the slowdown in economic growth, right? So Jitun, during your presentation just now, you mentioned about the recovery potential in terms of the consumption is still very huge given all those statistics. But reopening already happened in early of this year. So the recovery seems to be losing steam. So is it just, it takes time, or the market is waiting for some catalyst?
Okay, there's a few ways to look at things. I think I was just talking to one of our team members outside as well. So, so the question is the economy losing steam, right? So that's the main question that people are asking about China. So the best analogy that I have is, okay, so imagine if you are stuck in, you know, like a Chinese stuck in your home for the last 3 years. You have always wanted, oh my goodness, I've not had 鲍鱼, 鱼翅, your suckling pig for 3 years. So what do? First day when you go out, you just go and whack 鲍鱼, 鱼翅, right, for the next 7 days. So all of a sudden, all the restaurants' revenue all go through the roof because everybody wants 鲍鱼, 鱼翅 and suckling pig, right? And after you had 7 days of 鲍鱼, 鱼翅, what do? I think I just want simple wanton mee, right? So I think this is what we are seeing now. We have this explosive revenge eating, spending after 3 years of lockdown in China. So if you look at the retail sales in December, January, February, it's very, very high, all the way until Chinese New Year, right? Then after we had our feel of or your 鲍鱼, 鱼翅, then subsequently you just want something light, right? Then after that, they restart again. Hey, it's been a while since I ate my 鲍鱼, 鱼翅. So we start again, right? So I think we are at this point in time whereby people are sick and tired of that revenge eating, spending, watching movie, whatnot. So we are going back to that a bit of a lull before we carry on. So that's one. And the other thing is also related to what you have mentioned earlier in terms of tourism. Right, so I speak to companies all over Asia, so people are waiting for the bus loads or the plane loads of Chinese. But where are they, right? Where are they? They're not in Penang, they're not in Bangkok, some of them in Singapore, but where are they, right? So people are asking that question. So we there's a statistic that I want to share with you. So out of 100 people who had passport before COVID, okay, how many percentage, what is the percentage of those people who have passport now? Because we all know, right, passport will expire, right? So you are stuck in your home for the last 3 years, you can't possibly renew your passport, right? And the turnaround in zero-COVID policy was so fast, so furious that very people had time to go and queue up to renew their passport, right? So the answer is, out of 100 people who had passport pre-COVID, only 30 of them have passport now, right? Only 30% of them have passport now. So that's why the rest of the 70, even though they want to go out and go to Penang to eat char kway teow, go Bangkok to eat a pad thai, but they cannot because there's no passport, right? So that's why if you look at the consumption in China, you go Sanya, right? You go to all the 5, 6 stars hotels in all the nice cities in China, they're all full because Chinese can't leave the country. And to a certain extent, even if they can leave the country, if you go to the Western world, you go to US, you go Europe, even Japan, Taiwan, you will be discriminated, right? So a lot of them, and this anecdotally from my friends who are there, so a lot of them are just reluctant. They don't mind coming to ASEAN because we are okay, right? We are okay with them. Then if not, then they just spend their money onshore, right? So I think a lot of these, scenarios actually explain the reason why there has been a bit of a slowdown. And the other thing is also that I think a lot of people have been over optimistic in terms of the recovery. So once you turn on the tap, you expect everything to be back to normal, right? So I think it will take some time. Yeah.
Yeah, can I just add on that?
Sure.
I think I remember reading an article, the queue for to get a new passport or even renewal is not very common. I mean, it's very common in Asia, you long queue, right? It also happening in the United States, And what happened is that during a pandemic, a lot of this so-called, because they outsourced to a third party to handle all this, the visa handling and processing. And during the pandemic, they all has been stopped, terminated. And now to reactivate them back is actually takes time. Yeah. So I think even the tourists coming from US is very slow. It's not they don't want to come out. It's just that I think if you look at, I remember reading a report, I mean, you can wait as long as like 3 to 6 months, to get the appointment, even for interview. So that is a long process. So this recovery is going to take time. I mean, everybody was thinking that we are living in a perfect world. The moment the economy opens up, you can just immediately go out. It's not that way. So you need to be a bit more patient to see some of these flight number to increase, the number of tourism start to come to the different part of the world. Yeah, it's going to take time.
Yeah, so if to summarize the answer for the question just now, right? Chinese, they are now eating wanton meat, but soon they will eat back bao yu, but we need to be patient, right? So maybe due to the time constraint, I will taking this last question regarding related to our home country. So Gan Leong, just now you mentioned about the interest rate difference could be one of the key reasons why our ringgit has been so weak. So are you seeing the possibility that our central bank might want to hike rate in the near future to actually support the currency?
I don't think so, actually, because from an economic standpoint, if they were to increase interest rate when you don't really need to, because I think our fellow panelists here did highlight that we don't have the inflation problem that we are seeing in the Western economies. A lot of things in Malaysia are still subsidized, especially back then, our petrol prices are subsidized. Now electricity prices are going up slightly for the T1, right? So essentially, because of all these subsidies, we are not seeing the inflation problem. So we don't need to increase. If we were to increase it, everyone's mortgage payment will go up, car loan payments will go up. That will cause an unnecessary recession in the country. So I think there are other measures that Bank Negara is actually looking at in how they can interfere and defend our currency. I think one thing is to make exporters repatriate their foreign income back in Malaysia within 6 months, or how maybe try to get the GLICs or the our big pension funds to actually recuperate all the investments from overseas to bring it back to Malaysia. I think these are some of the measures that they can actually implement, but I do not think that they will increase interest rate to defend the ringgit.
Yeah, so seems like we might be approaching the tail end of the monetary tightening for Malaysia as well. So with that, we'll come to the end of this panel discussion. So I hope everyone has some key takeaway with them today. So once again, thanks panelists for their time.
Thank you. That was indeed a very, very inciting and igniting session. And I hope everyone enjoy it as much as I do. Once again, thank you all of our esteemed panelists and our moderator to make this a very exciting session and give us their ideas on what they see moving the markets in the days and months ahead. So now, ladies and gentlemen, for those who are watching online, we have come to an end to our event today. Once again, thank you all for joining our online seminar. And for physical attendees, we still have some announcements to make, so bear with us for a little while longer.